It's past 2 now. We can start.
Yeah. Okay.
So yeah, let me just welcome everyone back to the lectures and last day. 2 more sessions to go. So make sure that you get the most out of it and ask questions as usual. All right. Okay, we can start.
Okay. So everyone, thank you for coming. Thanks for sticking around until the last day. So the plan for today is I'm going to do a quick recap as usual, and then we will work with the firm productivity estimation for a bit in the first part of the lecture, and then I'm going to move on to trade policy. So in trade policy, I plan to cover tariffs, a little bit of dumping duties, and then we'll talk about quotas, and I'll end with export subsidies. So that's the plan for today. Recap. The first 2 lectures, we talked about the idea of comparative advantage. We said that trade happens because countries have comparative advantage in different goods. And the different models that we saw tell us where that comparative advantage comes from. So Ricardian says it comes from technology. HO says it comes from endowments. The other good thing about HO is we can talk about distributional issues. So we talked about the Stolper-Samuelson theorem, the Rybczynski theorem, and then we moved on to new trade theory. So we started out with Krugman. We saw the differences between new trade theory and the neoclassical models, because new trade theory also talks about gains coming from variety, gains coming from the fact that there are pro-competitive effects of trade because you relax the perfect competition assumption, right? We also take into account increasing returns to scale in new trade theory. And then finally, we introduce the one of the most used models today in trade, which is the Melitz model, right? And the Melitz model tells us that there is a lot of heterogeneity within sectors, and it lines up very well with the data. So it can explain things like, why do only some firms export, right? So the Melitz model tells us that only some firms export because productivities differ widely across firms, and it's only the most productive firms that can jump the barrier, right? So that can actually cover that fixed cost of exporting and expand and export to international markets. And while doing that, these firms take resources away from the less productive firms that will then exit the market. Okay, so that was the Melitz model in a nutshell. And then yesterday, we then introduced the gravity model, which is an empirical estimation model. We estimated a few versions of the gravity model. And then what we did was there were a few points that I wanted you to remember from that gravity estimation. First is the very basic gravity model regresses trade flows, right, on the left-hand side. So it's typically trade flows from country I to country J. On the right, you have distance between the 2 countries and the GDPs of the 2 countries, right, of country I and J. But we then saw that when you take into account everything that comes from theory, so everything that comes from the Eaton-Kortum model, the Krugman model, once we take all that into account, there are a few things we need to do to augment the gravity model. First, we need to control for multilateral resistance. We do that by using panel data, right? And we add importer and exporter fixed effects. The second thing we need to do is do a better job of controlling for trade costs and trade barriers. So the more the variables you can put in addition to distance, the better your estimation will be. So things like common language, whether countries share a border, whether they're island countries, all of those variables will help with estimation. And then the final thing we saw was that you have to account for selection. The fact that certain countries do not trade with each other at all. And if you go back to the theory that comes from the Melitz model, that is possibly because none of the firms in those countries are able to cover the fixed costs of exporting. So we saw how using the Helpman-Melitz-Rubinstein procedure, you can correct for that, right? Which it sort of combines this Heckman selection model to account for selection in gravity. So if you want to do a rigorous gravity estimation, then you should be controlling for selection. Now, it may not work often. So I sometimes tell my students that if the least you can do at least is check for robustness of your results after accounting for selection. So even if you don't have that as your baseline model, you should be checking how everything changes once you control for selection using the Heckman selection procedure. Okay? So that was a quick recap of everything we did. Today, what I'm going to do is look at productivity estimation. So, and again, this is important because as we know from theory, from the Melitz model, productivity is very important in international trade, right? So productive firms are the ones that export. Trade liberalization often results in changes in aggregate levels of industry productivity. So it's important to know how to estimate productivity. Now, there's a related literature on estimating markups that is pretty recent, I would say starting from 2012. I won't have time to go through markups. So what I will do is I will briefly give you the references, and markup estimation is on the slides. So for those of you who can follow on your own, you're welcome to look at the slides. If not, just look at the readings that I give you. So let's start with the basic OLS for productivity estimation. So you have firm level data, you want to estimate firm level productivity. Okay, so what is the first cut? The very first thing you can do, which is easy, is to just regress some measure of output on the variable input. So X is labor and material typically, and then capital stock. And then the way people calculate TFP is they just take the residual after having estimated that production function with OLS, right? Now, the reason they look at the residual is because the idea is fixing the inputs. Firms that can produce more output are more productive, right? So that's what the residual is going to pick up. But then what we saw yesterday is that there is a problem if you just run OLS, and there are two problems actually. So the first problem is this beta K, right? So this coefficient on capital, the betas are also called input elasticities because they track how output changes when you change input a little bit, right? So that beta K is a problem. And the problem is that productivity is hiding in the residual. So if I call productivity omega T, so here's the residual decomposed into omega T and mu T. Right? So productivity omega T is hiding in this residual. And the problem is that the firm can observe omega T. So the managers of the firm will be able to observe their productivity draw, but we as econometricians cannot observe the productivity draw. Right? So what happens is once the managers observe the productivity draw, they are then going to pick capital depending on their observation, right? So what that means is capital is actually endogenous. And so if you just estimate this using OLS, there is something called simultaneity bias. The fact that capital, stock, and output are chosen simultaneously, that is going to bias your estimate of beta K. And note that beta K is important. It's the elasticity with respect to capital stock, right? The second problem is the exit problem. So as we know from the Melitz model, once the firm draws its productivity, it's only going to survive and produce if the productivity is greater than a certain level. If not, it's going to exit. And so you're going to have this selection problem again, because you will only observe firms that are in the market, right? So that's the problem. Now, how do we solve this problem? So to do that, you can look at the Pavchnik 2002 paper that really was the pioneering paper to do this Oli Pekki's productivity estimation in the literature, right? So what Pavchnik does is she starts with this profit maximization, right? The problem for the firm. And she argues that capital evolves in the following way. So this equation here is the evolution of capital. And it says that the firm, the capital stock of the firm in period T minus 1 is just the capital that it starts out with minus depreciation plus the investment. And the way the firm works is the following. It's going to observe its productivity draw in period T, omega T. We are not going to observe it. The firm observes it. It then forms an expectation of omega plus 1. That is its productivity in the next period. And then it knows that it has KT amount of capital stock in this period. So given its expectation of future productivity, it is going to decide on its investment level IT such that it has KT plus 1 in the next period. Okay. So what this is telling us is that the firm's investment is really dependent on its expectation of productivity, given what it has observed in this period. So in a sense, if you look at investment, you get a sense of what the firm thinks its productivity is going to be. So that's the whole idea. The idea is let's use investment in physical capital, IT, as a proxy for productivity, because we know that the firm is choosing IT based on its expectation of productivity. right? So that's the whole idea. So if you get the intuition behind Oli Pekis, then the estimation is not an issue, because most of these canned programs are going to give you the estimation. Okay, so what are we going to do? We're going to run the Oli Pekis to take care of this simultaneity problem from the investment rule, the fact that firms invest based on their observed productivity. And we're going to take into account the selection problem because of the exit rule. So we're going to tackle both. And in order to do that, the Oli Pekis procedure runs in 3 stages, right? So the first stage is we are going to estimate an equation that looks like this. So output on the left-hand side. On the right-hand side, you put in your variable inputs, typically materials and labor are the variable inputs. And then you're going to stick in a polynomial function in KT and IT. Now, this can be a 2nd degree polynomial, 3rd degree polynomial, it doesn't matter, any polynomial function. And the idea is that this IT here in this polynomial function will proxy or will pick up what the firm thinks its productivity is, which is the omega t that it can observe, but we cannot observe. Now, once you run this estimation, you can back out beta hat, right? Once you back out beta hat, then you can go to the 2nd and 3rd stage estimation. So the next thing you want to do is calculate this particular left-hand side. So y output at t+1 minus the beta hat that you calculated from the first stage, or you estimated from the first stage, times xt+1. Okay? And then you can just regress that. Ideally, that's a function, as we know, of beta naught plus beta k, kt+1 plus omega t+1 plus mu t+1, right? The error. Now, we know that this omega t+1 is productivity, and it has an observed component. So this expectation omega t+1 conditional on omega t kt+1. This is what the firm can observe, right? Or at least this is the expectation that for the firm given its draw in the earlier period. And then you have the eta t+1. This is idiosyncratic. Even the firm doesn't know. It's a random productivity component. Okay? And so we don't worry about that. So then we know that this expectation of omega t+1 is itself a function of omega t, because that's what the firm is using to predict the future productivity draw. Okay? So then that reduces to just beta k, kt+1 plus some function of the omega t. Right, and going from here, you can see that that's just the polynomial minus the beta coefficient, because the beta k capital coefficient is hiding in the lambda, right? So we can just take that out, and then plus just the residual here. So that's going to be the final regression that you want to run, and the beta k coefficient is going to come out of that regression, right? But before we do that, we need to correct the selection. And how do we do that? It's just like remember in the gravity model with the Helpman, Melitz, Rubinstein, we had that Heckman procedure, right? So what do? You just estimate the probability of staying in the market. You estimate a probit model of whether the firm stays in the market in that period or not, or it's not present. You then get the predicted probability of staying, and then you just stick that into that function we derived in the previous page. Okay, so that will then account for exit. So 3 stages. Stage 1, run this particular equation here to get your beta coefficient. So back out the beta coefficient on the variable inputs, then run your probit estimation, back out the estimated probability of staying. Once you have both, then all you need to run is this final regression on this last line, which is yt minus beta xt+1. And regress that on the capital, on a polynomial function of investment, capital, and the probability of staying, and then plus the error term. Okay? Once you run this regression, you will back out beta at k. And then you have finally all 3 betas that you need, right? The betas on the variable inputs and the beta hat on the capital. So that's the idea. You start by estimating betas on variable inputs and then finally estimate the capital coefficient. So it proceeds in 3 stages. This is just to give you an intuition for what it does. As I said, most CAN programs will do this for you, so you don't have to worry about the coding itself. Now, there is big literature on trade and productivity. So I urge you to look at not only the Pauchnik paper, but there's a lot of work by Jim Tybout, who's at Penn State, who work on productivity estimation. There's also work by Praveen Krishna and Devashish Mitra on trade liberalization in India that also uses a lot of these techniques, right? So you can look up their web pages if you want more updated studies. Now, just broadly for most countries, what you find is that with trade liberalization, there is some evidence of impact on productivity. There's evidence that average costs go down. So there's evidence for the pro-competitive effects of trade as well. So you find evidence for both productivity improvements and changes in markups with trade. Okay, now there is a section in my slides on markups and trade. As I told you, I don't have the time to cover it, but those of you who want to do this can look up markup estimation. The good thing with markup estimation is once you estimate productivity, then once you have backed out those betas, right, those input elasticities, if you do that well, then markup is just one step further. So you can actually use those elasticities to calculate the markup. It's a pretty straightforward calculation. Okay? So I urge you to look at the paper by, let me see. Yeah, the DeLocker and Wojcinski 2012 AER paper. So this paper, what they do is they estimate revenue productivity like we are going to do here. And then they use those elasticities, the betas, to then calculate markups. And in order to do that, what they do is use this formula on this page here. So this is and this you can find in their paper, the DeLocker Wojcinski 2012. So here you have a formula for markup as just a function of the input, the elasticity, right, on the variable inputs that we estimate, and then times this alpha, which is nothing but the input share of that variable input. So if you're looking at materials, this is just the materials expenditure, that is firm sales, and then you just have to multiply that by your estimate of the input elasticity. The output elasticity of inputs. Okay, so really everything is about estimating the betas. Now, there is another procedure called Levinson and Petrin. And the only thing you need to remember about Levinson and Petrin is that it is exactly like the Oli-Pekis method that I just told you about. But instead of using investments in physical capital to proxy for productivity, these guys use material expenditure, material inputs. And the reason for that is because particularly in developing countries, the problem you will run into is that you're not going to have investments in capital stock every year. Okay, because firms don't invest, not all firms invest every year. So in order to avoid that problem, they use the material input instead of investments. And then you do exactly what you did with Oli-Pekis. So Levinson Petrin is Oli-Pekis, but with materials as the proxy for productivity. And then finally, I want you to think about the ACF correction. So you will often hear about this in productivity estimation. It's called the Ackerberg, Cavies, and Fraser correction, ACF. And the point here is ACF argue that, look, you cannot treat labor differently from materials. So if you're running the Levinson-Petrin method, you're using materials as the input that proxies, right, for productivity. So they say that you cannot really treat labor differently from materials. And so they propose a method where in the second stage, both the labor and capital coefficients are estimated jointly. Okay, so it's a small correction where there's a joint estimation of labor and capital. Labor is not treated differently. And so the ACF correction is something that is now pretty standard in the literature. So most people will use either Oli-Pekis or Levinson-Petrin depending on the data and then apply the ACF correction method. Now there's another method by Wooldridge that people often use again in the literature, and that method is again these methods are all quite similar. They use the same concept of everything is estimated in stage. So that gives you some efficiency gains. But, you know, Levinson-Petrin with ACF is pretty much, is fine. That should work, at least as far as the revenue productivity function is concerned. Okay, so I'm going to go to the estimation now. Are there any questions at this stage before I move to the estimation?
Yeah, there's one which asks if the gravity model can be extended to understanding intra-country trade.
Gravity can be used in all kinds of ways. So I have seen gravity models run within country, across countries for trade flows, immigration flows, FDI flows. Yeah, it's a very versatile model. Yep. Anything else that can?
No, that's it. I think we can move ahead.
Okay, so let's move on to the actual productivity estimation. Now, I have this data from CMIE, right? So this is the Provis database. A lot of you probably have used this database in the past, I'm sure. So what I'm going to do is run these different productivity estimations. Now, an important point here is all that I'm doing here is estimating what we call a revenue production function. So what is a revenue production function? It's when you estimate everything in dollars, right, or rupees. So when I have output in rupees, material inputs in rupees, wages in rupees, then I'm actually looking at a revenue-based production function. The problem with that is it can conflate markups and productivity. Right? Why does it conflate markups? Because if firms are charging a markup over their variable input costs, right? So you have the cost, you have the wage, you have the cost of materials. If firms are applying a markup, then that is going to also be included in this productivity estimation. For example, two firms may not really be, so it may not be the case that one firm is more productive than the other. But if that firm is charging a higher markup, right, that will show up as higher productivity because it will still show up as for a fixed level of inputs, this other firm is producing more output. While it's just the case that it's not producing more output, it is simply charging more for that output. So its prices are just higher. So that's the problem with running this in a revenue form. The way you can tackle that is to try and run it in a physical form, which we call as TFPQ instead of TFPR, which is revenue productivity. TFPQ is very difficult to run because you need data on quantities. Right. Another way that people do it is to calculate firm level price deflator. So if you can calculate prices at the firm level, you can use those prices to deflate all your revenue numbers. And that way, what you can do is get an estimate of FPQ. So I would urge you to look at a Smeets and Wojcinski's paper on this, because that's what they do. They calculate these firm level price indicators. So Smeets and Wojcinski, it's in my slides. You can look at that paper to follow that procedure. Again, it will be similar. They will be using these Levinson, Petrin, Oli-Pakes types procedures, but before they do that, they will deflate the revenue numbers, okay? The rupee or dollar value. So that's Smeets and Wojcinski. Those of you who really want to get into this, really the most recent and the most rigorous approach is the Amit Khandelwal and co-authors. I think Nina Pauchnik and Penny Goldberg are also on it. And they have an Econometrica 2016 paper that actually uses Indian CMIE data, but it also uses data at the firm product level to do this TFPQ estimation very, very rigorously. So that would sort of be the gold standard at this point. But it is a very rigorous procedure. So unless you're very focused on productivity estimation, I would encourage you to try and use the Smeets and Wojcinski. It's just easier. All right, so let me get started here. What I'm going to do is I'm going to use the CMIE data. So I'm going to do some basic cleaning here. So in terms of cleaning the variables, what I'll do is if output is less than 0 or 0, I'm going to drop those observations because it means the firm is not really operating. Right. Similarly, I have to do similar things for raw material expenses. If it's negative or 0, or then I drop. I also drop if net fixed assets. So net fixed assets in the CMI data is a way to capture capital stock, right? So this is how much machines and tools that the firm is using to manufacture. So I'm going to drop if that is negative. And then I'm going to also drop if wages are 0, though I don't think we have any of those observations. So let me just run that cleaning procedure here. Okay, so 0 observations deleted means there's nothing there, but that's because I have done this before. Okay, so I have already cleaned the data before. So let's now run these K densities. So I find that running a K density is useful because it gives you an idea of the distribution of these variables, right? So let me do a K density of output. Okay. So that is the K density of output. Why does it look weird? Anyone? Is there something I should be doing differently here? So I'm looking at the distribution of output, of the value of output. Why does it look so strange? What is the problem? Yeah, so very good. So I should be taking logs, right? Because these are very, very big dollar values. So I should not be plotting densities without logging these numbers. So what I'm going to do is I'm going to first log these, and then I have the logged values of the variables, and then I'm going to run the K densities using these logs. So there you go. Now it looks a lot more reasonable, right? So that's because I took logs of all of these variables. So I have taken the log of output, materials, wages, and capital stock. Now, material and wage are the typical variable inputs people use. Sometimes people put in energy and fuel. You can do that, but make sure that your data is not spotty, because you don't want to be losing too many observations in the hopes of running a fancy estimation, right? Okay, so at some point you want to be summing these things. I'm not going to do that. We don't have time, but it's always good to sum or summarize your variables, right? Just to check that the distributions look okay. There are no massive outliers. Okay, so let's get on with productivity estimation. What is the most simple way to run productivity estimation? You just run an OLS procedure with output on the left-hand side, and then materials, wages, and capital stock on the right. So that's what I'm going to do here. Okay, so here are my coefficients: materials 0.7, wages 0.2, capital 0.06. Can you tell me something about returns to scale based on these coefficients? What can we say about returns to scale? This is, well, it's almost constant, right? So it looks, it is almost constant returns to scale. Why? Because if I add up those coefficients, 0.7 plus 0.2 plus 0.06, it comes up to roughly around 1. So this is constant returns to scale here. Now, what do I do to estimate TFP? Remember that you just take the residual. So take the residual, which is output minus all of your coefficients times the material, wages, and capital, right? Times the input. So I run that. So that will give me my log of TFP. And then I can basically plot this log of TFP. Okay, so this is look strange because there's quite a few negatives. So there's a very long tail here. So what you might have to do, I haven't cleaned the data enough, but often cleaning the data will really help with this kind of estimation. So you don't want any extreme values. So it might be a good idea to chop off, 1% of your observations on the top and at the bottom. So that's often helps. In fact, it gets worse when you start doing markups because you start getting very massive outliers. So you might need to trim the data a little bit. Okay. Oh, someone else is sharing screen. Hang on. So what should I do? Did I get cut off?
No, you're still there, but your screen is not visible. You have to make sure that you are the one sharing the screen.
Oh, okay. Yeah.
Yeah.
Okay. So now what I'm going to do is for those of you who are interested in my do file that is available, I have generated some indicators for foreign firms, so foreign presence. And I have looked at the spillover effects of FDI, right? And so if you want, you can follow my code and look at FDI spillovers and how they impact productivity. So that is this section of the code. I don't have time for this, so I'm not going to do it, but you can follow the code. So what I'm going to do is I'm going to look at the impact of trade liberalization on productivity of Indian firms. So how do I do that? How do I look at the impact of trade liberalization on productivity? So an easy way to do this, now remember, I'm still in this OLS type, so I'm not really doing a great job yet of calculating productivity because I'm still using OLS, right? But in order to just get a quick sense, what I'm going to do is run this following regression. So regress output on material, wages, capital, and then I'm going to include the tariff, right? So ln tar is the tariff, the import tariff on the particular sector in which the firm is, right? So I have data on the tariff. If I run this regression, what am I trying to get at? What I'm trying to get at is it's a way of, instead of calculating TFP as the residual and then in the second stage running that residual on the tariff, I'm just running everything in one stage. Okay, so all I'm doing is I'm running output and controlling for all the inputs and then looking at whether tariff is then related to the output. So that's another one stage way of looking at the impact of tariffs on productivity. Now, theoretically speaking, what is our expectation on the sign of the tariff? So we would expect that with trade liberalization, if the tariffs go down, increase productivity. So typically the argument in the literature is
I think your voice broke a lot. Maybe you could repeat.
Okay, so where did you, can you hear me now?
Yeah, the last 10 seconds before I interrupted.
Okay, so the theory, right? So what I was saying is that theoretically, our expectation is that trade liberalization, which is captured by this reduction in the import tariff, should be associated with an increase in productivity. And that is because when tariffs go down, there's more competition for firms, and more competition means that firms are they become more efficient because they invest in better technology, they reduce any managerial inefficiencies and so on, and that leads to higher productivity. So that's the theoretical expectation. So my expectation is that the coefficient on tariff is going to be negative, which means a lower tariff means more trade liberalization is associated with an increase in TFP or productivity. So let me run this regression and I will show you what we find. So what we find here is actually the opposite, right? So what we find is that tariffs are actually associated with higher productivity. In other words, a lower tariff is associated with lower productivity, which is actually against the theory in a way, right? But we're going to solve that puzzle. So just hang on. Just note that right now we have found the opposite effect from what theory would predict. Now, of course, I have panel data, so it makes sense for me to run a fixed effects regression, because note that I can control for a lot of firm level unobservables, right, by introducing a firm fixed effect. So I'm going to run a fixed effects model and see what that does to my results. So even using a fixed effects model, and I have run that using Stata's xtreg command, FE, right? The other thing I have done is I have now started clustering the standard errors at the NIC 2-digit level, which is an industry level clustering. And what this does, and you should always do, is always cluster your standard errors by industry. It's allowing for shocks within industries to go across, to spread, all right, spillovers within industries in any shocks. So when I run that, I still find that I have a positive and counterintuitive to theory coefficient, but it is also statistically significant. Lower tariff means lower productivity. And the reason I'm interpreting this as productivity is because I have conditioned on the inputs, right? So I'm saying conditional on the inputs, if you produce less output, then that's less productivity. Okay, so all of this I have done using the OLS procedure, but I have already argued to you that it's not a good idea to use OLS. Okay. So I see a question coming from, why have you used tariffs to proxy trade liberalization? Can you not use inputs imports and exports? Now, the problem with imports, you can use imports and exports, but the issue with that is it's less exogenous, right? Because productivity and the level of imports could be endogenous. They're determined together. So what you will do is you will use tariffs that are slightly more exogenous. They're set centrally, right? And they're a better way of proxying for the policy environment. Why do we find a negative coefficient on capital? This is exactly what will happen when you have fixed effects. So fixed effects And essentially, I haven't run any Oli-Pekis correction here, right? So the capital coefficient is not going to be estimated right. In fact, what you find is unless you use the Oli-Pekis type procedures, you're going to underestimate the coefficient on capital very strongly. So you will find a capital coefficient that is very much towards 0 if you don't correct for that simultaneity problem. Okay, so this is why it's not a good idea to run this OLS that way. So let's do the Levinson-Petrin and ACF corrections. I'm going to start running everything, and I'm going to store the estimates because at some point I want to put it on a table to compare the estimates. So I'm going to run the following: OLS, fixed effects. I'm going to run LP. LP is Levinson-Petrin. I'm going to run an LP that also corrects for attrition. So remember, in the Oli-Pekis, there were 3 stages, right? You correct for exit, you correct for simultaneity, right? So this LP procedure only corrects for simultaneity. LP attrition corrects for both simultaneity and attrition or exit. Okay. Now, the command that I like to use for these Oli-Pekis type procedures is called prod-est. You can download prod-est. It's an edu file, and you can use it along with data. So just type install prod-est and it'll do it for you. So let's run the OLS command first, and I'm going to be saving all my outputs. So I'm going to run that. Right, so that was your standard OLS. If you remember, we ran this before. Then I'm going to run a fixed effects estimation. Okay, and then you get that weird negative on capital. That happens with fixed effects, because with fixed effects, you're only looking at changes within the firm. So the identification in fixed effects is coming from changes in wages, capital, and materials related to changes in output. So it's a very, very different type of estimation. Next, I'm going to run the Levinson-Petrin procedure, but without correction for attrition. And for that, I use prod-est, and then the left-hand side here is LND output. Free variables, what do we mean by free variables? These are your variable inputs, right? So typically materials and fuel, energy, whatever you have. Don't put materials here because this is Levinson-Petrin. So in Levinson-Petrin, materials is actually a proxy for productivity, right? So it's not a free variable. The only thing we have here is free is L&D wages. Then I'm telling Stata that my proxy variable for productivity is material inputs. Okay, so that's why I say proxy L&D materials. The state variable, which is the one we are worried about, that's your fixed input, right? And that is capital stock. So L&D cap NFA is the state variable. I'm going to tell prod-est that the method I want to use is LP. You can use Oli-Pekis as well. I suggest not doing that for India because sometimes a lot of the firms don't report investments. So LP is a better one to use. And then finally, I'm telling, because I also want to include firm fixed effects, I tell Stata that the ID, the company ID is the company number, and then T, the time variable is year use. Okay. So once I do this, I'm going to run the productivity estimation and I will save it.
Asha, one question though. I think this file you haven't shared in the Dropbox folder.
So this is not because I have shared the log file. So a lot of people said it's better to share the log file because it also reports all the output.
Correct.
Right. So you can get the commands out of that log file.
Okay.
Okay. So let's look at our capital coefficient here. So I want you guys to look at the capital coefficient has gone up to 0.09. If you remember, the initial capital coefficient was 0.06, right? If you remember from your OLS. So you have already bumped up the capital coefficient a little bit. That is exactly what you would expect when you correct for simultaneity and using this Levinson-Petrin procedure. So the next thing I'll do is I'll also correct for attrition. Now, correct for attrition, all you need to tell Stata is just use this option ATTR with the prod-est command. So if you use ATTR, then Stata will run that 3-stage estimation that I told you about, right? Where it runs that probit and then sticks in that predicted probability to control for exit. So I'm going to run that here as LP attrition. And the reason it's taking time is because it bootstraps, right, for the standard errors and stuff. So it will take some time to run. Okay, there you go. Now you see how once you correct for attrition, you're getting an even bigger bump on the capital, right? So now we've gone up to 0.138 on the capital stock, right? So basically, this is getting better and better and better. So now let's run with the ACF correction. Now with the ACF correction model, you cannot use output. You have to use value added as your variable, right? So for that, I have generated the value added as output minus materials. Okay, that's your value added. And then I run the productivity, the prodest command, and I tell Stata that I actually want ACF. ACF is the option for ACF correction. And I tell Stata that I'm using value added option. So this VA option here tells Stata that this is a value added output. Okay, so then I'm going to run all of this for the ACF correction. I will also save the output. Okay, so because I have run on value added, note that I'm not going to get a materials coefficient here, right? So wages 0.3 and capital 0.58, right? So the right thing to do is to be using, if you can, again, not always you can, I mean, your data set may not always be amenable to all of these things, but the ideal thing you could do is run either Oli Pekis or Levinson Petrin correcting for attrition and using the ACF correction. So that should be the minimum that you should do for now. All right, so let me compare all of these using. Okay, so unfortunately this isn't, I'm not sure. So, okay, ideally if you cut and paste this somewhere, you will get a nice neat table that you can use. But let's compare these capital coefficients again. So you can see how as you go, as you get better and better with your estimation strategy, you get higher and higher capital coefficients. And that is exactly what you want, right? Because you're correcting for simultaneity bias on your K, on the capital coefficient beta K. Now, once you run this, you can just use these coefficients to then calculate TFP as the residual, like we did with OLS. So just use these beta hats and you can get your TFP estimates. Okay. One quick thing on markups. As I said, it's very easy to calculate markups once you have your betas from say you use the Levinson Petrin procedure with the ACF correction, you have gotten all your betas. Then it's simply a question of generating the markup as the beta hat M in this case. So this is the materials beta hat multiplied by this output or total sales divided by the total raw material expenses. Now there is a small correction you need to do. So you have to generate output as output minus epsilon here. That's a small correction you have to do. But then after that, it's very easy to generate markups. Now to do this, please look at that DeLocker paper that I have put on the slides to see why that markup is calculated using that formula. Okay. So the reason I'm going to do this is let me do this particular markup calculation, and I will do a density of markups for India. Okay. So I have used my productivity estimation to calculate the betas, and then I calculated the markups using the DeLocker procedure. So now, so here's my estimate of markups for Indian manufacturing firms. Note that this looks very similar to markups in many other countries. So what you have is a mass at around, centered at around 1, okay, because you're looking at the markup over marginal cost here. But then you have a pretty large tail of firms that are charging very high markups. So here you almost have firms here charging 2, 3, 4 markups. And this looks very similar to other countries. I have some data for Ethiopia, for example, that I use, and very similar story, right? A very big tail of firms. And the reason I want to conclude by showing you the impact of tariffs on the markup. So let's think about this a little bit. If you remember, I told you that the revenue-based production function, which is what we have been doing here, all of this I have done is revenue-based, right? Because we're using data on output, wages, material expenditure. it tends to conflate productivity and markups. So when we looked at the impact of tariffs on productivity, we found that a lower tariff is associated with lower productivity. Right? And we saw that and said, look, that is very counterintuitive. Theory tells us low tariff means it should be high productivity. Actually, what might be happening, and this happens always, is that we might have been capturing the markup effect rather than the productivity effect. So what happens to markups theoretically when tariffs go down? So if tariffs go down, then there is more competition, right? When there's more competition, what would you expect markups to do? You would expect markups to go down, because there's more competition. And that is why that markup effect is probably contaminating the productivity effect. So even though lower tariffs may be associated with higher physical productivity, because it's also associated with a lower markup, you're not able to pick that up. And what you're really picking up with the revenue-based TFP is simply the effect of tariffs on markups. Okay. So if my hypothesis is true, I should be able to see this in the data, right? So if I look at the impact of tariffs on markups, I should be able to get to see that low tariff means lower markups, right? So let me look at that here. And when I run that regression, so I'm going to run a fixed effects regression. And what you see is that is exactly the case, right? So a lower tariff is associated with a lower markup in Indian firms, and that effect is statistically significant, right? So the p-value 0.004. So this actually provides some evidence for my hypothesis that maybe what we are picking up is just the markup effect. It is not really a productivity effect because we haven't estimated ATFPQ. If you really wanted to look at the impact on pure productivity, then you should be running a TFPQ estimation, which, as I said, you can do by either calculating firm-level deflators a la Smeets and Wojcinski, or running a full-blown econometrica Khandelwal et al. Style production function estimation of TFPQ. Okay, so I think I will stop there with the productivity estimation. Are there any questions? I have glossed over some of these parts here in the file, but you can play around with it because it's available to you. Any questions?
Yeah, 3 questions. One is how do you deal with outliers? I think you've already mentioned that. I think the question was whether you drop them or replace them, like Winsorize them or something.
Exactly.
Again, depends on case to case.
Yeah, exactly.
Either way, I think would work, right?
Yes. So yeah, Winsorize or drop, trim. Yeah.
So the second one is epsilon equivalent to TFP residual? So this is for the correction that you do while doing
yes, epsilon is the residual. So in order to know why that is true, you have to read that paper, because so when you derive the actual markup formula, you will see why you need to adjust for the epsilon. Okay, so look at the paper, because I haven't had time to go through the derivation.
Okay, so the third one is, so markup has a moderating effect. Can it not be controlled? I'm not sure what that question is.
You can. So moderating effect means, yes, I guess I think you're saying that it goes in 2 different directions, right? In a sense, that's the problem. The problem is the productivity effect goes in one direction, the markup effect goes in the other direction, right? So that's an issue. And you can control for markup. That's one way of doing it, but really the best way to do it is to just calculate TFPQ. That is the best way to do it. You could introduce LNMU or the markup as a control variable when you're running your productivity estimation, but that's not really telling. If you don't find anything, then you cannot say much with that. So I would say that the best way to deal with this is just do a TFPQ regression.
Okay. I think, can you explain the other way of calculating outlier apart from dropping? You can look at Winsorizing. Let's not get into these statistical things.
Yeah. So just look up Winsorize in Stata, and it will tell you what to do. Okay.
So we can move ahead.
Okay. All right. So that was the end of the actual estimation, and I'm going to now move on to the policy part of the course. Okay. So now that we have, so what I have tried to do is to give you a sense of the theory. We then moved on to estimation, because you can estimation is important because it helps you to evaluate the theory often, right? So you can see if your results actually are in line with the theory. If they're not, then you can look at why they're not in line with the theory, and so on. So if you think of policy, right, I always think that evidence-based policy is about first thinking about what the theory has to say, collecting data, and then actually looking for evidence, right? So that's why I have structured the course so that you go from theory to the estimation and then finally policy. So it's never a good idea to do policy without thinking about what the theory implies, and what, if there is evidence, if you can actually find evidence for the theoretical implications. Okay, so let's move on to policy. Oh, before I move on here, I want to do two quick things. I know that there were some questions that I didn't answer. I said I would think about them. One was about the unemployment issues in the Hexter-Ohlin model. So the question was, all of these Hexter-Ohlin models use or assume full employment, right? What happens if there is unemployment? Now, I have looked, and there is a big literature apparently on rigidities, right? Labor market rigidities. Now, when do you have unemployment? Typically when the wages cannot adjust to clear the market, right? Either this is, you can have things like the minimum wage, or you can have search frictions, for example, that are present, which is why you have unemployment. And there are quite a few papers that incorporate things like the minimum wage and search frictions into Hexter-Ohlin style trade models. So I think that just looking for those papers would make sense. But what I can tell you is that often the Rybczynski effect and is not going to hold if you have unemployment. So for example, if you have a minimum wage and the wage cannot adjust downwards, then the Rybczynski effect is not going to hold. Okay. So for those of you who want more, who want to look into this, there is a literature that incorporates labor market frictions, including search cost and minimum wage policies, into HO models. So that was one point that I wanted to discuss. The other thing is there was a question about the Balassa-Samuelson effect. I think the idea with the Balassa-Samuelson effect is that when you have two sectors, so like in the Ricardian model, if you remember, we have two sectors, same as HO. When you have a traded sector and a non-traded sector, so you have one sector where international trade is possible, and then you have another sector where it isn't. So for instance, let's take computers and haircuts, right? Haircuts are not tradable, computers are tradable. And when you have productivity differences in the tradable sectors, but you don't have productivity differences in non-tradables, then what can happen is that if you, let's say you have the US and India, right? US is way more productive in computers. India is not as productive in computers, but the productivity levels and haircuts in both the US and India are the same. Then because workers in the US have to be paid a higher wage due to the higher productivity in the computer industry, what ends up happening is that haircuts are more expensive in the US than in India. Right. So what happens is that the wages or the price levels because of wages tend to be higher in advanced countries relative to developing countries, even though the productivity levels in non-tradables are not that different. So that is your Balassa-Samuelson effect. Now, the reason I think someone said it's related to what I was talking about is you can think about this in the context of the Ricardian model. So when you have two sectors, and productivity levels in both of these sectors across two countries are different, how does that impact the prices and wages? So that's, you can use that kind of Ricardian framework to think about the Balassa-Samuelson effect, but they're not exactly related. The Balassa-Samuelson effect is a lot more about explaining why advanced country prices tend to be higher, even in non-tradables. Okay, so let me quickly move on. I just wanted to address those two because I said I would. I'm going to talk about tariffs. I'm going to talk about anti-dumping duties very briefly. I won't spend too much time on that. I do want to talk about quotas and export subsidies. Okay, so that is the plan. Gautam, how are we on time? I can go ahead for a while, right? And then just alert me when we are nearing break time.
Yeah, maybe 25 minutes.
Yeah, okay. So I think what I'll do is I'll do tariffs and dumping, and then I'll take a break and then move on to quotas and subsidies. Okay.
Yeah, do you want to give any reference for the labor market rigidity in the Hexter-Ohlin model?
I Actually, I can't. Let me do that during the break. I think I did find a couple of papers, and I'll just put it in the chat function during the break. Is that okay?
Yeah, I think there's some interest. Yeah, so
Okay.
we can
I
go
will
ahead.
do that. Yes. Okay. All right. So trade policy. Now, broadly speaking, there are different trade strategies that you can use to aid development, right? So from where India is sitting right now, we want growth rates to pick up. We want economic development, and there can be different strategies that the government can use as far as international trade is concerned to aid or to boost development, right? These are two policies: import substitution and export promotion. So what is import substitution? Import substitution is when you restrict imports so that you substitute away from imports towards domestic production. And the whole idea is that you then develop capabilities in domestic production, right, in domestic sectors. The other idea is to actually promote export. So that's an export promotion strategy, which is very different from import substitution. So for export promotion, those of you who are familiar with trade policies know that export-led growth, the big example is the East Asian tigers, right? So the East Asian tigers and countries like Germany, Finland used export promotion pretty aggressively for development, particularly the East Asian countries. Okay? Now, the question is, does it always work? So what is export promotion? Export promotion is things like you encourage exports by you may be providing R&D subsidies. You might be encouraging exports by developing export clusters, like export processing zones. You give subsidies, right? Not just for R&D, but also for exporting. And so there's a range of export promotion policies you can use. Do they always work? Well, they worked fantastically for the East Asian tigers, but that doesn't mean that they will always work. First, for the East Asian tigers, conditions were very conducive, right? So, for example, you had it was the end of the Cold War. The global conditions were great in that there was rising demand. Okay? We had the IT revolution at some point in the 90s. OECD countries, there was very strong demand coming from these OECD countries for exports from the East Asian tigers. Fairly open environment for capital flows. So it was easy to attract FDI, for example, at that time. So a lot of what China did was encourage joint ventures. So invite foreign companies, multinationals to come in and invest. Okay, and then that's how they learned, right? So there were joint ventures in autos, in computer manufacturing, and so on. That actually helped them to grow, to develop the capability. So that's one strategy. The other, but I want to highlight that it's not always a great strategy. For example, one of the issues with that level of government support for exports is that debt levels rose in a lot of the East Asian countries. In fact, they then faced the late 90s, the East Asian financial crisis, because debt levels rose so high. In China, we know that there is a problem of debt. I don't know if you guys have heard, but have you heard of the concept in China of ghost cities? So ghost cities are these cities that are just sitting there. With all of this infrastructure investment has gone in, but growth did not really pick up. And so they're like, empty cities. So you can click on that link and it'll take you to these, to these very disturbing dystopian pictures of just infrastructure sitting there, right? Without any, yeah. So here's the article on the emptiness of China's ghost cities. So, right. So you just have all of this infrastructure massively built, but not being used. So that's the idea there. Now, so we have to be careful. It doesn't, export promotion may not work. It worked for the East Asian countries because the conditions at that time were conducive. And we also have to be careful about debt levels when you have that level of government spending. The other idea is, of course, import substitution. And the argument there is that there's infant industries that need to be protected. And so you can you protect these industries by levying import tariffs. Now, the countries that used the import substitution idea are countries in Latin America, for example, Brazil, Colombia, a lot of them used it. India, of course, used this extensively, right? Import substitution. Does it work? Well, there isn't much evidence that it works. It may work to a certain extent. So infant industry protection can work to a certain extent, but there are some conditions that need to be satisfied for infant industry protection to work. Right. So firstly, and also it cannot work if you keep the protection on for too long. Then it starts resulting in a lot of welfare losses if you don't remove the protection quickly. Now, it could allow domestic capacity building. It can work in some cases, but there are some concerns with an import substitution policy. First, it will encourage inefficiencies and rent-seeking behavior, right? For example, we're going to talk about this more when I talk about quotas, licensing, right? When you start having licensing, there is rent seeking. So people are going to bribe government officials to get licenses. You will have large, unproductive firms just sitting there, not paying. And Gautam can talk about this too. The whole idea of zombie firms, just unproductive and sitting there, right? High costs of inputs for domestic firms. This is a very, very important point. So what people often forget is when you're protecting an industry, often you're also raising the cost of intermediate inputs for that industry. Okay? So for instance, if you're protecting, you're putting tariffs on things like auto parts, then what you're doing is harming your own automobile manufacturing, because those automakers cannot get parts at a competitive rate. Lack of gain from varieties. Those of you who lived, I don't know how many of you are old enough to have lived through the 1990 liberalization phase, right? So if you were born in the 80s, like I was, and then you lived through 1991, which was the liberalization, you would have seen that before liberalization, you only had maybe to pick one or two cars, right? You had the Ambassador, the Fiat, and one other car. But once you had the liberalization, we know what it is like now, because you have access to an infinite variety of cars. Now, if you look at the idea that consumers like variety, remember the love of variety function, then you don't have those gains from varieties. Okay, so let's talk a little bit. I'll open it up a little bit, because I know people wanted to talk about this Atmanirbhar Bharat campaign. Now, the question is, where does the Atmanirbhar Bharat fit here? So is it, the question is it more of an import substitution policy, or is it more of an export promotion policy, or is it a combination of the two? Okay. So now that's where the problem is, because ideally it should be, the idea should be self-reliance. As an idea goes against the idea of comparative advantage, right? Because comparative advantage says the biggest gains come when you specialize in making what you're good at, and then you export that commodity, and then you import the other commodity. So the idea of comparative advantage is a little bit, let's say, it's not in line with the self-reliance idea. That said, of course, we cannot be reliant in key areas. There's a national security argument that people make, or food security argument people make, is that you can't be completely reliant on another country for, say, defense, right, or food, because then that is a question of national security. So that's a valid point, right? But then we have to be very, very careful that export promotion, in the interest of export promotion and in developing domestic industry, we don't just move on to an import substitution and protection type of regime, right? Where you're simply protecting domestic industry, because that we know that is associated with welfare losses. So the question, I think, is going to be where Atmanirbhar Bharat is actually going to be. Are you interested in substituting and protecting? Are you interested in protecting inefficient domestic industry? Right, that's the one extreme. The other idea, or hopefully that is what the government is aiming for, is that you put in policies that will actually encourage exports. So export promotion by making sure that your domestic industry is competitive enough. And we have talked a little bit about policy there, right? We talked about how can you encourage exports? Make it easy to export, right? Bring down the barriers to exporting, make licensing easier. Maybe give R&D subsidies for innovation. So make it easier for firms to invest and innovate, for instance. So all of those policies are, not only are you developing local industry, but you're also encouraging exports and export competitiveness. Where exactly Atmanirbhar Bharat will finally lie, is it totally import substitution or export promotion? That's, I think we have to see. Okay, because right now I am seeing a lot of policies where defense imports are going to be banned and so on. If it's a national security argument, I get that, but the danger is that it then spills over into other sectors as well, right? And then you start getting into massive protection of various industries. Okay, so let me hear from you. What do you guys have to say? Gautam, is anyone saying anything? Anything
Right.
that
So there's one question about WTO being perceivedly unfair towards developing countries. Basically.
Right. So if you go to developed countries, and I have spoken to policymakers in developed countries, and they are arguing the opposite. They're saying the WTO is being unfair to developed countries because it's being partial to developing countries, right? So there are certain policies that the WTO, so there are certain things that developing countries can do, that are allowed to do, that developed countries cannot do in the WTO. Okay, and developed countries are mad about that. But of course, developing countries have a valid point because they are saying that, look, our domestic conditions are completely different. We have to worry about poverty, inequality issues. And so, we deserve those exemptions, right? So I think with the WTO right now, both sides are arguing their say. In any case, I wouldn't worry much about the WTO because I don't even think it has any teeth at this point. So really, in international circles, at least in Geneva, I know that people are even worried about whether the WTO will exist in a few years because of what is going on with the US and China, right? If both the US and China in their negotiations step outside the WTO, then the WTO itself may be under threat. So we're not even sure if the rules-based system is going to continue in international trade. Is there anything else, Gautam?
There's one question about multilateral trade organization that I think you just answered. The other
yes, that is under threat right now.
Yeah. The other is about Atmanirbhar Bharat being front for inviting investments into India, as opposed to so it's an investment policy to drive in investments.
To bring in investments. Okay, so that is a good strategy. I mean, that is a strategy that China used at one point, right? Where it brought in investments from abroad. It encouraged a lot of joint ventures between foreign companies and Chinese companies. And that really was why Chinese automobiles, why that sector took off, actually. So that is not a bad idea if that's what they're doing. My concern is only that in the interest of self-reliance, that they don't start engaging in protecting a wide range of industries, because we know that there are welfare effects associated with that, right? So for example, consumers end up paying more because you're protecting your domestic industry. Second, intermediate inputs become more expensive. That can actually hurt competitiveness, export competitiveness.
Okay, so can one see this within the context of whether a country is a price maker or a price taker for a particular industry?
Very good. So yes, I am going to go to that soon. So once I start talking about tariffs, I'll start talking about small versus large countries, price takers and price makers. I'll get to that. Okay, are there any other questions? So I think...
What will be the future of regionalism and FTAs, especially after the failure of RCEP?
That is a very, very, very good question. I think people are worrying about this a lot. So ideally, so if you think about the theory, then what you want is you want trade liberalization multilaterally, right? In other words, you want all countries to reduce tariffs. You don't want much regionalism because there are problems with regional trading agreements. So there's these problems of trade creation and trade diversion, because when you become a group, all you are doing is not probably increasing trade, or you're just diverting trade away from certain countries towards other countries, right? That's what free trade agreements do. So you don't want too many regional trade agreements. That said, the bigger the regional bloc, the better. So big regional trade groups like TPP, right, the trade CPTPP or RCEP, these are definitely very positive developments. We don't get the best, because the best would be all countries lower tariffs. But at least if we can get these big trading blocks, I think that would be an improvement for welfare. But with India pulling out of the RCEP, I don't know. I think that is a missed opportunity. I am hoping that they reconsider. I hope that this is just a temporary thing, and that they don't intend to stay out of the RCEP forever, because I do think that that would be a missed opportunity. So the WTO has realized that trade liberalization per se is a lost cause. And so it is encouraging regionalism. But I think too much regionalism, as Jagdish Bhagwati's work has shown, it leads to this spaghetti bowl concept, right? So the spaghetti bowl is when you have so many regional agreements that it's very hard for people to know which rules apply where, and that actually raises the costs for firms of exporting. So it actually raises trade costs when you have too many regional trading agreements. So I think, unfortunately, the world we are in today, maybe the best way to go ahead is to have large regional trading blocks. But that also means that India needs to be open to be a part of these trading blocks, right? And stepping away from the RCEP, in my opinion, is hopefully it's just temporary, and that it's not something that the government will continue to do.
Yeah, so I think that was a good answer. So there were some comments. Can regional trading lead to trade diversion? So
Yes.
deglobalization and that sort of questions. I think there's one other question which was like, so we probably have had one policy in the past which was inviting investments into India, which was Make in India sort of an initiative. And
Right.
how is that
Yes.
different from the Atmanirbhar Bharat?
Actually, that is a question we should be asking the government. I am myself confused about that. I think Make in India, again, I think Make in India, self-reliance, all of these are very good principles, but the question is going to be about how you implement it, right? So to do Make in India, if you invite foreign investment, right, you open up to foreign investment and joint ventures, I think that's promising, because China has done that in the past with very good, successful results. And also note that when you have more foreign investment, the literature shows that that's good, because you can have technology spillovers and knowledge spillovers. You can raise the productivity of local firms. So if they're planning to do Make in India that way, then I think that's a good thing. But my question is, is Make in India just another way to protect? Right? So all of these campaigns, if they focus on improving domestic industry, improving competitiveness, and boosting exports, I think that's great, because that is going to improve growth and generate jobs. But if that is if using these policies, this Make in India and Atmanirbhar Bharat, if we're going to then say local is good and simply going to protect local industry, there's nothing wrong with saying local is good. But then if you're going to be protecting, right, that is never a good idea, because there are huge welfare losses. So if you're slapping on tariffs and not allowing imports, and that's how you're keeping local industry competitive, that will have welfare losses associated with it.
Okay, I think we have covered a broad range of topics associated with this. And I mean, there are obviously going to be more questions coming in, but I think we can, move ahead and
I think
not get stuck
always,
here. Yeah,
sure. I agree. But one thing I just want to urge everyone is, please, when we are thinking about these policy questions, I think it's always a good idea to appeal to the theory, right? So I think always going back to the theory and evidence is very important when we talk about policy, because policy without that is dangerous, in my opinion. So that's sort of the final point I want to. Okay, so let's actually start talking about the policy. So what we're going to do is we are going to consider each policy at a time. And what we will see is that the effects are very different depending on two things. So for every policy you evaluate, you have to ask yourself the question, one, what is the market structure that you're thinking about? So if it's a perfectly competitive, or at least close to a perfectly competitive market structure, that's very different from being in, say, monopolistic competition or a monopoly or a duopoly, right? When you have imperfect competition, trade policy impacts are very different. So the first thing you want to think about is, what is the market structure? Second is, are you a price-taking country or price making? This was a question that was raised earlier. So the small country versus large country is very different. So trade policy for a country like India will look very different from trade policy for a country like Belgium, for instance, right? So what we're going to do is we will look at both small and large country, and I'm also going to look at the market structure and what role it plays. All right, so let me start with a small country first. Now, this diagram is probably familiar to a lot of people who have an econ background. So what we have here is on the left-hand side, we have the domestic market and we have the import market on the right-hand side. So we're considering a country that is importing at this point. Okay. So if you look at the left, in the domestic market, P star is going to be the world price for that particular import. So if you think about India and a good that India imports, let me say that's maybe electronic parts, right? So electronics, India is an importer of electronics, let's say. This is the world price P star. Now, one thing here is this D curve is the demand curve in India for electronics. S is the supply curve in the domestic market. Now, what is the autarky price here? So the autarky price for electronics is going to be where demand meets supply, and that's very high here. So one thing, note that the autarky price here is always higher than the world price. Why is that? Because this is a sector where India is importing. If it's importing, it means that it doesn't have a competitive advantage in electronics, which means its autarky price will always be higher than the world price P star. Okay, so if the world price is P star, then India is going to, at that price, the demand is going to be C naught, supply is going to be Y naught. So the difference between C naught and Y naught is going to be imports at the free trade price P star. Okay, so let's move on to the import market. So on the right-hand side, what I have drawn here is the import demand curve M. So M is import demand, and what it is showing you is that at these various prices, as the price goes down, you can go back to the domestic market, demand is going to increase as the price goes down, supply is going to go down, and the level of imports is going to rise, right? So as price goes down, imports rises, and that is the M curve here. Now, for a small country, what happens is that the export supply curve is just perfectly elastic at the world price. So at the world price P star, a small country can import, or the export supply that it faces from the rest of the world is infinite at that price. So it can import any amount. Now, that's not true for a large country, and we will come to that case later. So for now, small country and perfectly elastic export supply curve. So let's think about what happens when the domestic government imposes a tariff. When the government imposes a tariff, what happens is that the export supply curve shifts up to X plus T. Right? Because now in order to import, or in order to bring their goods into the country, exporters have to pay a tax, right? So they have to pay a tariff at the border. And so that means that the price goes up and the export supply curve shifts up from X to X plus T. That means this has gone up, the price has gone up from P star to P star plus T. At that higher price, your consumption is C1, production is Y1, and the difference is new level of imports. And as you can see, imports have gone down because you have a tariff now. Okay? So that's the impact of the tariff on imports. So let's look at what happens to welfare, because that's where we are going with this, right? We want to know if a tariff is good or not. So to look at welfare, we are going to look at consumer surplus, producer surplus, and we're going to look at government revenue collection. So let's look at consumer surplus. So consumers earlier had welfare, consumer surplus is the area over the price and under the demand curve, right? So the earlier consumer surplus is that section right there, above P star and below the demand curve. Now with the tariff, consumer surplus goes down to the triangle above P star plus T and below demand, which means that consumers have lost A, B, C, and D. So that's the loss in consumer surplus. Producers get producer surplus, which is the area below the price and above the supply curve. So earlier they had that little triangle there, and now they have the bigger triangle, and that means that their gain is A. So consumers lost A, B, C, but producers gained A. What about the government? The government gets the tariff revenue C, because it's the tariff multiplied by imports at that point. Right? So new imports is just C1 minus Y1, this part, and then you multiply that with the tariff, that gives you government revenue C. So if you put all of this together, consumers lose A, B, C, D, producers gain A, so what's left is B, C, D, but then the government gets C, and so what is a loss is your deadweight triangles B and D. So B and D are the deadweight loss associated with the tariff. So what we have seen is that when a small country imposes a tariff, there is always going to be a deadweight loss of those sections B and D. Okay? So if you're a small country, tariffs are always associated with a welfare loss. What happens if you are a large country? So if you're a large country, then the key difference is that you're going to have an upward sloping export supply curve. In other words, at a high price, you will be able to import a larger amount. So your export supply is an upward sloping line instead of being perfectly elastic at the point P. Now, let's run the exact same thing like before. So what if the government comes in with a tariff and it's a large country government? If it's a large country, the export supply curve shifts up to the top to X plus T. What happens here? So let's draw a line going all the way from that point to P star plus T. So we start out with the price P naught, which is right here, where imports were equal to C naught minus Y naught, which is what we're calling M naught. So the initial equilibrium was where M intersected X at point P naught. Imports were M naught. The government came in with a tariff. The export supply curve shifted to X plus T. Let's look at what happened to prices. If you look at the domestic market, the price after the tariff is now P star plus T. But then what has happened to the world price? So what happens here is, because this is a large country, by imposing a tariff, this country has actually driven down the world price to P star from P naught. We started out at P naught. After the country imposed a tariff, it drove down the world price to P star, and so the domestic price is just P star plus T. Okay. Now, can anyone tell me what this is called? This idea that a large country, by imposing a tariff of T, has driven down the world price from P naught to P star has a name. Does anyone know what that is? What do we call this effect, where a large country putting on a tariff can actually drive down the price, the world price? Anyone?
There doesn't seem to be any answers.
Okay, so it's actually called the terms of trade effect. Okay. So what is terms of trade? Terms of trade is the price of exports divided by the price of imports. Right? So what this country has done is, by putting on a tariff, it has driven down the price of its import, which means that it has an improvement in terms of trade because the price of imports has gone down in the world market. Now, let's remember the terms of trade effect is going to be very important. So it's the idea that a large country, because it puts on a tariff, it has impacted the world price. A small country cannot impact the world price by doing anything, right? But if you're a large country and you put on a tariff, you can drive down your price. The way intuitively it works is that you're so large, your share of the world market is big, right? And so if you put on a tariff, then you're going to exert downward pressure on the price, right? Because you are protecting consumers, demand is lower at that price. And so that's going to drive down the world price because you're so big. So let's do the welfare calculation here. And this is where you will see something interesting. So let's look at consumer surplus. Consumers earlier had the triangle, the area above P naught and below the demand curve. So now they have the area above P star plus T and below the demand curve. So consumers have lost A, B, C, and D. Okay. What happened to producers? Again, same story. Earlier, they had that section below P naught and above supply. Now they have a much larger section. So what they gain is A. But let's talk about the government. So the government gets the revenue T. Now, where is T here? T is the difference between P star and P star plus T, right? That's T. So it's this entire distance here between P star and P star plus T. That's tariff revenue T. Multiplied by the level of imports, which is just the C1 minus Y1. And what you find is government revenue is C plus the section E. Right? Now, if you put all of this together, consumers lose A, B, C, D, producers gain A, so that leaves you B, C, D, but government gets the C and the E. So essentially now, in order to look at the welfare calculation, we are looking at how E is different from B and D. So B and D, it's a welfare loss. That's a deadweight loss of the tariff. However, there's going to be a gain of the section E. And that gain happens, if you can see on the picture, it happens because there was a terms of trade effect. So because the country, by putting on a tariff, could influence the world price and drive it down, it actually gets a gain from that tariff of VAT. So if the gain is bigger than the loss, then what you're going to do is actually have a welfare gain from a tariff, right? So a large country can gain welfare if that E section dominates B plus D. If B plus D dominates E, then there is still a net welfare loss. Okay, any question on this? I think this is a good time to take a break. I'll take questions and then break, and then we'll come back with the equations.
I don't think there are any questions. If
Okay.
we break now, maybe we can start at 3:40.
Yeah, okay. 3:40 sounds good. Yeah, okay.
Thanks.
So see you then. Yeah.
Hey,
Hello?
yeah, can you hear me?
Yeah, I can hear you. Can you hear?
Yeah. So, so final session now.
Yes,
Seems
that is
like a
true.
long time now.
Yeah. Well,
Um,
it's been productive. I think
Absolutely.
I have appreciated all the questions and the interaction. I wish we could interact better, but the platform I think the platform is good, but I guess it's never like actual interaction, right? Like physical interaction.
Yeah, it's a lot better than I anticipated
Yes.
before it started. So it was really nice. So again, so let's start the final session then. There's
Okay.
one suggestion about starting a professional LinkedIn group or something, but I think participants, if they're interested, they can do that. They can share emails and stuff like that. Okay,
Yeah.
so
Okay.
let's start.
All right. So what we're going to do now is just set up a very simple model, right, that can allow us to look at these welfare effects. And particularly, it's going to be useful because we can use this model to look at how the effects are different based on whether you're a small country or whether you're in a large country, and also based on the level of competition in the market. Okay. So this is a very simple model. It's a baby model. So we start with a utility function, and the reason we're doing this is we want to get a sense of welfare at some point. So we start with utility, which is simply there's just two goods, right? So we have C naught H. Think of C naught as a sort of numeraire good. So you can think of it as money, right? And plus U of H CH. So CH is the consumption good, right? So utility is a sum of C naught and the utility coming from the consumption good. Demand for the consumption good is given by the demand function D of P. So D is just the demand function here for the consumption good. And then the numeraire, which is your C naught, it's perfectly traded as a price of 1. So as I said, the price of the numeraire is 1. Just think of it as money. So C naught H is then I of H minus P prime of D of H. So what this is saying is that the money is sort of like whatever is left over is your income minus what you spend on the consumption good. So what your income minus your expenditure on the consumption good will equal the numeraire. Okay. Now, for production, we want to keep it really simple because our focus here is on the consumer, right? So for labor, we're going to say that labor is the only factor of production. There's no capital. And 1 unit of labor will produce 1 unit of the numeraire good, C naught. Now, the important assumption here is we're going to start with perfect competition in the labor market. So labor market is perfectly competitive, which means that the wage is going to be equal to 1. We have a cost function, which we're going to call as C of Y. So C of Y is the cost function on the production side. And there's only one traded good. This is subject to a specific tariff. So a specific tariff is when you write the tariff, when price is just the world price plus the tariff T. Okay. So P star here is again the world price. Think of this as the world price of the imported good. T is the tariff, and P is then the domestic price in the domestic economy. So what is welfare here? So welfare is defined, we know the utility function. The utility function is just C naught, the numeraire, plus the utility coming from consumption of the consumption good. So I have already shown before or defined that the consumption good or the numeraire consumption is just income minus what you spend on the consumption good. So that's IH minus the P prime D of H plus the utility coming from the consumption of the consumption good. Okay. So I'm going to differentiate welfare with respect to the price because then I can set the optimal tariff. Right. So let's differentiate the welfare function with respect to price. I have given you the details below here on this slide. So del W over del P, the derivative of welfare with respect to price is, let's go back to this function here, right, that on top. So if you differentiate that with respect to P, I don't worry about the income. The derivative of this expression, the middle expression with respect to P is going to be P times the derivative of DH with respect to P minus DH, and then plus the utility prime, right? So UH prime times del D over del P. So that's what we get by differentiating the welfare function with respect to P. So then what we know is from the FOC for utility maximization, we know that negative P plus U prime is equal to 0. So that's the first order condition from utility maximization. And because that is the case, we know that UH prime equals P. And so I can substitute that in here. So UH prime equals P. So those terms get canceled. And we're left with the simple expression that the derivative of welfare with respect to prices is simply negative D of P. Once we have that, then what we're going to do is look at welfare and see what dW over dt is going to be. So what I'm interested in is to know what the optimal tariff is that the government should set, right? So let's express welfare as a function of prices and total income in the country. Now, what is total income in the country? In other words, what is GDP of the country? GDP comes from several sources. Firstly, there's labor income. So the size of the country is L, the wage is 1, right? It's normalized to 1. So that means total labor income in the country is L. The government gets tariff revenue. So that is T times M, where M is imports. And then finally, the firms are making a profit of PY minus CY, where PY is revenue and then C is cost. So welfare can be written as a function of prices and income, where income or GDP is defined in that way. So now let's take the derivative of the welfare function as defined here with respect to the tariff. Now we know that del W over del P is simply negative D of P. We have already shown that. So I'm going to say that expression is negative dP times dP over dt. Plus, let's take each of these second terms into account. So the derivative of the second term with respect to t is first m plus t times dm over dp plus y times dp over dt minus p times dy over dt minus c prime dy over dt. So the way I got that expression is I just totally differentiated that welfare function with respect to t. Now, after some algebraic manipulation of this, which is given in the second step, we can arrive at the third step where the dw over dt, t is the tariff, by the way. So dw over dt is just t times dm over dp times dp over dt minus the second expression here and then the third expression. So let's take one expression at a time. So dm over dp times dp over dt is measuring how imports respond to price. So this expression here is really driven by the import elasticity. So how responsive are imports to the price? Okay. Second expression is how the tariff changes, how the world price changes when there is a tariff. So this tracks the change in the world price for a small change in the tariff. And then the last expression looks at the difference between P and C prime. So the difference between price and marginal cost multiplied by how the tariff changes production, right? So let me take each term at a time. What we're going to call this is in a sense the impact of T on the tariff. So this is what we will see later will be an important term. The second term is the terms of trade effect. So what the second term measures is by imposing a tariff, can you actually change the world price of that product, right? So that's why we call the second term a terms of trade impact. And then the third term is picking up how the tariff affects production. So we know that the tariff is intended to increase production in the domestic economy, right? And that is multiplied by this differential between the price and marginal cost, which is a measure of market power. Okay. So let's take each, we have to remember, so this is something that you will need to, we'll keep coming back to that expression there, right? So just remember that there are three terms in that expression. So let's take the first case, small country, perfect competition, what happens? So let me go back to the term here. If it's a small country, then we already know that this terms of trade effect is going to be 0, right? Because the small country cannot impact the world price. So dp star over dt, we don't have to consider for a small country. Similarly, if we are in a perfectly competitive setting, then we know that price will equal marginal cost. There's going to be no differential between price and marginal cost. So I can disregard the third term. So small country perfect competition means I just have to worry about this first term here. So that means dw over dt is just t times dm over dp. That's coming from the first term. Now, given that this is the derivative of the welfare function with respect to t, what is the optimal tariff that I'm going to set? To get the optimal tariff, I have to set tariff at the point where dw over dt equals 0, right? So that's how you find the optimal tariff. And we can see that dw over dt, for that to be 0, what you want is t equals 0, which means that the optimal tariff is going to be 0. So for a small country with perfect competition, the optimal tariff is always 0. That's the best that you can do. If you check second order condition, you will find that that is less than 0. Okay, that is point number 1. The second is what happens if economically speaking, the optimal tariff is 0, as we have derived. It's not politically feasible, and usually these countries will have a very small tariff, like a 10% tariff, right? So the question is, what is the welfare loss from a tariff? And to do that, what you can do is take the welfare function and get a Taylor series approximation of the welfare function around a tariff level of 0. Okay. So if you take a Taylor series expansion, then what you can show is that the difference between welfare at a very small tariff and a tariff of 0 is actually quite small. And it is given by this number here, half of t squared times dm over dp, which we can also write as half change in p times change in m. And if you go back to the graph that I showed you first for a small country, this half change in p times change in m is exactly the area of those two deadweight loss triangles that I showed you. Okay. So essentially the welfare loss, which is those two B and D triangles, the really small ones, that can be very small if you have a small tariff. So the point here is, if you are a small country and it is politically not feasible for you to have 0 tariffs, and if you have small tariffs, you will still be okay, because the welfare loss, which is those deadweight triangles B and D, coming from a very small tariff is small. So it is actually manageable. The problem is when you start having large tariffs, right? That's when you're going to have massive welfare losses if you're a small country. Okay. Okay, so what happens when you are a large country? Now, when you're a large country, let's still assume that you're in a perfectly competitive environment. So let's go back to that equation I told you that we will always go back to, right, which is the derivative of the welfare function with respect to the tariff. In a large country, if we're still in perfect competition, we can disregard the third term because price will equal marginal cost. It's perfect competition. So I can eliminate the third term. All I have left is these first two terms in this equation. Right? So I'm going to say dw over dt is just the combination of the first two terms. I'm going to set that equal to 0, and I will solve for the optimal tariff. So the optimal tariff is t star, which is defined in this expression here. That is the level of tariff at which dw over dt equals 0. Okay? So this is why we say this is the optimal tariff. And for a large country, as you saw, the optimal tariff is the tariff where your gains are maximized. So the little E rectangle that we saw on that graph, if you remember, that minus the B plus D, that's the net gain from the tariff, right? So T is the tariff at which that gain is maximized. The welfare gain from a tariff is maximized. So how do we interpret this optimal tariff? So if we know if imports are equal to exports, so if you have trade balance, M equals X, then dm over dp times dp over dt is just dx over dt. So we can write it that way, right, with some manipulation. So then I can write the optimal tariff, t star over p star, as 1 over dx dp star times p star over x. Similarly, I can also write the optimal tariff as a function of these two terms on the right. Okay, so let's look at what these terms are. So in the second equation, what we have shown is that the optimal tariff is an inverse function of the elasticity of export supply. Right, so Tx over dP star, P star over X, that's just the elasticity or export elasticity. So the optimal tariff is a function of the export elasticity. Similarly, the optimal tariff is also a function of the import elasticity. So here we have the import elasticity, dm over dp, p over m, multiplied by dp star over dt, dp over dt. So what we've shown is that the size of the optimal tariff, whether it's high or low, depends on the slopes of the import demand and export supply curves, because they're functions of export elasticity and import elasticity. And that's actually easy to see from the graph, right? So if you look at the graph, what we're looking at is that for a large country, there's a gain because of the terms of trade effect, and there's a loss. So you want to maximize your gain by making sure that E minus B minus D is maximized, right? And that, if you can look at these triangles and the E rectangle, what you will see is these things depend on the slopes of the X and M curves. So that is exactly what those equations are telling you, is that where you can put on a high tariff or a low tariff will depend on what is the elasticity of the import demand and export supply curves in the facing the country. Okay. So that is what this slide is trying to say, is that the optimal tariff is determined by these external factors. Okay, so that was perfect competition. So let me summarize. If you have a perfectly competitive market, if you're a small country, you want to go with a zero tariff. If you're a large country, you have an optimal tariff that you want to charge. And that optimal tariff is a function of the import and export elasticities. Right? If you're a small country and you still want to impose a tariff, you will be okay, or your welfare losses will be small if you have a small tariff, like a 10% tariff. But anything more than that, and you will have substantial welfare losses. Okay. Now let's look at what happens when you have a foreign monopolist. So we are no longer in the perfectly competitive environment. We are in a setting where there is a foreign monopolist that is supplying. One way to look at this is, say, if you're in a market like in aircraft or something where there's only one global supplier. Aircraft is a duopoly because you have, or it's an oligopoly. But you can think about settings where there's only one major foreign firm that is selling that particular product, right? So that's the foreign monopolist. And this theorem is from Brander and Spencer, 1984. So if there's a foreign monopolist, it doesn't make sense for you to impose a tariff. Okay. So now the intuitive answer for that is, well, it depends, right? When do you want to put on a tariff when there's a foreign monopolist? You want to put on a tariff if you're able to shift some of the burden of that tariff to the foreign monopolist. If you are going to bear the entire burden of the tariff, it's not a good idea. But if some of that is borne by the monopolist, then it might lead to gains, right? So let's look at the maximization, the profit maximization problem for the foreign monopolist. So the foreign monopolist has profits defined as follows. So it's X, which is sales or quantity, times the price, right? And the price is P minus T because the monopolist faces a tariff to get those products into the country. And then minus the cost of the monopolist, which is C star X. We have a star here because it's a foreign monopolist, right? This firm is in the foreign country. So I'm going to take the first order condition here with respect to X, right? And then set that equal to 0. The second order condition is here, pi double prime dx minus dt equals 0. And so that gives me dx over dt is 1 over pi double prime, which is less than 0. So what is this telling us? If I put on a tariff, then X is going to go down because this is a negative relationship. So the tariff is going to decrease the level of imports in this case, which is intuitive. That is what the tariff is meant to do. The more important question is, what does the tariff do to the price that my consumers are paying? So if I'm the Indian government and there's only one aircraft maker that is selling aircrafts, and if I put on a tariff on imports of aircraft, of course, it's going to bring down imports, but what is it going to do to the price that that Indians are paying for that aircraft, right? So for that, we need to know what dP over dt is. So dp over dt is p prime dx over dt. And I already know what dx over dt here is. So this is just equal to p prime over pi double prime. And that is greater than 0. So the tariff is going to reduce export sales and it's going to raise the domestic price. But by how much? Is it going to raise it more or less than the tariff? Okay. So what we're going to do is, let me just show that to you on a graph. So here we have the same foreign monopolist, and we have that monopolist, we're drawing the standard monopoly diagram. So here we have the downward sloping demand curve. So this is a demand curve in India that is facing the foreign monopolist. Here you have a marginal revenue curve. And so what the previous slide is showing is that this pass-through of the tariff to the price depends on what the demand curve and the marginal revenue curves look like. So as long as marginal revenue is steeper than demand, which we know happens for linear demand curves, right? So as long as we have a demand curve that looks linear like this, so that the marginal revenue curve is steeper, then we are going to get imperfect pass-through. So what is going to happen is we are going to start, suppose we start with marginal cost C star for the monopolist, right? So at that point, the monopolist produces at or sells at at X naught quantity, and the price is going to be P naught. So then the Indian government imposes a tariff of T, which means the marginal cost for the monopolist now goes up because the monopolist has to bear the tariff, right? So when you're bringing products in, you have to pay the tariff at T. And so the marginal cost goes up to C star plus T, which means the domestic price now, here marginal revenue equals marginal cost at this point. So price is going to now be P1. And so price P1 minus the tariff is essentially sitting here. So this is P1 minus T. So what this diagram has shown us is that if the Indian government puts on a tariff in a case where there's a foreign monopolist supplying, then the price, of course, for Indians is going to go up, but it is going to go up by less than the amount of the tariff. In other words, we have the same terms of trade effect that we had in the case of perfect competition, where India, by imposing a tariff, has brought down the world price. By the world price, we mean the price that the monopolist is charging or is getting, right, which is P1 minus T. So here, again, you have those C and D triangles and the E triangle. So what the theorem tells us is that the foreign supplier will partly absorb the tariff as long as we have that condition satisfied, which is that marginal revenue is steeper than demand. And if that is the case, then you are going to get a terms of trade effect. The minute you have a terms of trade effect, you can have positive welfare from the tariff, because the terms of trade effect is what determines welfare gains for the country. Okay. So let me go to Cournot duopoly. So what if you don't have a foreign monopolist, but you have a duopoly situation where you have a foreign firm, and then you also have an Indian firm that is selling the same product, right? So this is a foreign a duopoly model where you have two firms, one foreign and one domestic. So the foreign firm has pi star, which is X, and their profit is given by X times the price minus the tariff, minus their marginal cost, like before. But note that for the Indian firm does not have to pay the tariff, right? Because the government is protecting the Indian firm by putting a tariff on the foreign firm. So the Indian firm's profit is Y times P minus CY. That is the profit function for the Indian firm. Now we're gonna, this is a Cournot duopoly model. So the way we solve this is we are going to find the reaction functions for both the Indian firm and the foreign firm, right? So this is a standard way in which you solve a duopoly model. So we're going to get the reaction function for the foreign firm. So you differentiate pi star with respect to X, which is the quantity sold by the foreign firm, and you keep the Indian firm's quantity fixed at Y. Similarly, the Indian firm will look at its first order condition, or the reaction function will be you differentiate pi with respect to quantity Y, keeping X fixed, which is the foreign firm's quantity. Now we can plot these reaction functions. So if you're familiar with the standard Cournot model, these are just reaction functions for both firms. So here we have the quantity sold by the foreign firm, and here you have the quantity sold by the Indian firm. And what RR is the reaction function of the Indian firm. So this function is telling us that at each quantity X sold by the foreign firm, the Indian firm's profit maximizing response is to sell that amount of Y. Right? So it's tracing the amount, the quantity that is sold by the Indian firm as a response to what is sold by the foreign firm. Similarly, you have a reaction function R star for the foreign firm. And these curves here are just isoprofit curves. So these curves are telling you the profit level for different combinations of X and Y. And the direction here tells you that if you go down, so this is the Indian firm, pi, the Indian firm's profits are increasing as you go in the downward direction. Why is that? Because if you can look at the quantities, right? As you go down along these curves, you're reducing the quantity for the foreign firm and increasing the quantity for the Indian firm. So you are actually shifting the market share towards the Indian firm, and that's good for the Indian firm. Similarly, for the foreign firm, profit is increasing as you go in that direction because you are shifting market share away from the domestic firm to the foreign firm. Okay? Now, what happens to these reaction functions when you put on a tariff, right? So if you go up and think about the Indian government putting on a tariff on foreign sales, right? Then that means here it's a P minus T, right? So I'm going to have to shift the reaction function down for the foreign firm. So R star shifts down to R prime. So what does this mean? This means that because there is a tariff, for any given level of Indian sales, the foreign firm will sell less, right? Because it has to pay a tariff now. So the reaction function has moved to the left. The intersection between RR and R star is the Cournot-Nash equilibrium. So in this case, the Cournot-Nash equilibrium is at point C, right, where each firm is playing the best response to the other firm. And once the tariff comes in and the reaction function shifts to R star, the new equilibrium is at point D. So the new Cournot-Nash equilibrium in this case is point D. So what happens at point D is exactly what the government wants to happen with a tariff, is that we have shifted market share away from the foreign firm towards the domestic firm. So that's the whole point behind imposing a tariff here. Okay. So the tariff is a way to protect the Indian firm at the expense of sales of the foreign firm. So the question is this good, right? Are there, what are the welfare implications of putting on this tariff? And as I told you, the thing you want to look at for a welfare implication is to simply look at whether there is a terms of trade effect, right? Because that's what tells you if there's going to be a welfare effect. So to do that, what we will do is we're going to add the FOCs of the two firms together, the first order conditions of the two firms. That gives us this expression here. And then we're going to differentiate the dz over dt. So this is the response, what happens to total sales when you impose a tariff. And we're going to calculate what happens to the price when you impose a tariff. We are interested in the second expression, dp over dt. Why? Because that is what tells us what happens to the price with the tariff. Does it increase, and does it increase more than the tariff or less than the tariff? Okay, because that's what picks up the terms of trade effect. So dp over dt is less than 1 if the MR slopes down. So if you look at this condition and ask when is it less than 1, that happens if P star up or P prime of Z is greater than the denominator. So the numerator greater than the denominator. And that happens if this condition here is satisfied, right? So as long as the marginal, this is nothing but the marginal revenue curve. So if the marginal revenue curve is sloping down, as long as that happens, we know that dp over dt is less than 1. So what does that mean? That means that if I put on a tariff, then the increase in the price is going to be less than that tariff. So the price is going to go up by less than the amount of the tariff. In other words, there's going to be a terms of trade effect as well. Okay. So what we have shown is in the case of a foreign monopoly or in the case of a duopoly, these are all markets with imperfect competition. We still have welfare gains if there's terms of trade effect. As long as certain conditions are satisfied, it would make sense to have a tariff in these cases, in imperfect competition. Okay. Now, a little bit about profit shifting. So if you remember, I haven't talked much about that last term in that equation, right? So if you remember that tariff equation, the dW over dt that I showed you earlier, it had three terms. The first term was picking up the welfare loss from the tariff, the distortion. The second term was the terms of trade effect. And the third term is what we call the efficiency term, because it picked up the difference between marginal cost and price. Okay? So this third term that denotes efficiency, it doesn't always have to be positive. And so basically, if you are able to shift profits, like we saw with the Curno case, by putting on a tariff, the Indian government shifted market share away from the foreign firm towards the domestic firm, right? So even though profit will always increase with the tariff, that doesn't always mean that the third term will increase with the tariff, because the third term is not profit. It's essentially an efficiency based term, right? So profit shifting doesn't always imply that you will have welfare gains from the tariff. Okay. So what we can show is, as long as there's free entry in the home country, welfare will only go up if the import share in the industry is greater than the tariff pass-through. So really, the impact depends on all of those three terms and how they play out. So terms of trade effect will always lead to a gain, but you have to balance that out against the other two terms. And as long as that terms of trade impact dominates, you will have a welfare improvement with the tariff. Okay, so let me just recap what I said so far. So what I have said so far is, the impact of a tariff on welfare depends on a few things. First, it depends on whether you're a small country or a large country. If you're a small country and you're in a perfectly competitive environment, then you have the optimal for you is to have a zero tariff, or at best a very small tariff that will result in very small welfare losses. If you're a large country, then you can actually have a gain from imposing a tariff, and the optimal tariff, we calculated that, is going to depend on a few things. It's going to depend on the elasticity of import demand and export supply. Then we said, what if it's not a perfectly competitive environment? So what if there's a monopoly situation, or indeed a duopoly situation, where you have a foreign firm competing with a domestic firm? In all of those situations, as long as certain conditions are satisfied, for instance, you have a linear demand curve, marginal revenue sloping down, as long as those pretty basic assumptions are valid, then you are going to have a terms of trade effect. So that second term is going to be operational at that point. And so there is scope to have a positive tariff. So you can actually have an optimal tariff that is positive. So the overall sense is that a tariff is actually not such a bad thing. It depends on how big it is and whether you're a large country or whether you're a small country. For a large country, it actually makes sense to have a tariff, because it can actually lead to welfare gains. Okay, so at this point, is there any question that I need to answer? Gautam, anything on the section on tariffs?
Yeah, so there is one which is asking how and is Brand and Spencer different from the Metzler paradox?
I am not familiar with the Metzler paradox. I don't know. I'm not familiar with it. The Brander and Spencer is just a theorem that looks at imperfect competition when you have a tariff, but I don't know the answer to that question.
I think the Metzler paradox is talking about the paradox is that raising tariff leads to a reduction in the domestic price of the good. But I am not sure what the channels are. Maybe if they are different, that could be where they are different.
Right. Oh, okay. So that's a paradox of. Okay, I see. Yeah, I mean that means it is quite different. Though I don't know how that happens. I mean, I'm not familiar with that model, with that paradox.
Okay. So retaliation will not give the advantage. Sorry, 1 second. Something is popped up. Will not have the advantage for small country in case of tariff. So retaliation, I think she's talking about a tariff war. If a foreign country is raising the tariffs, if the small open economy or a small country responds in retaliation, will that have an advantage or not?
No. So yeah. So it's not. If you're a small country, then it's not a good idea to be retaliated. It's not a good idea to be putting any tariff, right? So it's always a bad idea to have a tariff, whether it's in retaliation or not. Now, when you're a large country, then what you can do is, if you're trading with another large country, so the U.S. China case, right? What you will do is one puts a tariff on the other retaliates. Both of them then are going to have a loss. Okay, so the terms of trade gain might be mitigated, and all you will end up is a welfare loss. So two large countries retaliating is a bad thing. For a small country, it's never a good idea. So the small country will always be hurt with any tariff, be it retaliatory or not.
Okay, I think related to that, there was one question earlier. How do you classify a country as small or large?
Oh, a good question. So typically we say large country. So it depends on the market. So for example, New Zealand would be a small country in general, but if you talk about the dairy industry, then it would be a large country. Okay. So it often depends on the markets. India would be a large country, let's say in textiles. It would be a large country in most agricultural products, but in aircraft, that it would count as a small country. So, and it also, of course, depends on the demand. So it's a combination of whether you're talking about which side you're talking about, right? So if you're talking about imports and demand, then India would be a large country by any means. Right. But if you're talking about export subsidies and being a supplier, then it depends on the industry that we're talking about. So it's mostly like economic mass.
Yeah, I think loosely it's about your ability to impact international prices, isn't it?
Yes. Absolutely.
Okay, I think there's no more other questions.
Okay. So let me move on to the dumping story. Now, I'm not going to be able to do justice to dumping because I can't go through there are models that deal with dumping and reciprocal dumping and so on. But there is just one point that I may want to make about dumping. And that is, so let's define what dumping is. I think most people know what dumping is, but the official definition is dumping occurs if the exporter is selling to a foreign market at a price that is below the market price in the destination country, or it's below its own domestic price, or it's below cost, right? So if you let's say you take a Chinese, I don't want to keep focusing on China. So let's take a Turkish firm, right? So if a Turkish firm is selling to India, then if it is selling below the market price in India, that's dumping. Another way to do this is it's selling below the price that it is selling in its own country. So it's selling in India at a price lower than it's selling in Turkey. That's another way of doing it. Or it's in fact even selling below cost. Now, of course, this is a very legal issue, right? So usually when countries put on a dumping case, they have a band of lawyers that will try and show that dumping is happening, and then the defending country will also have a band of lawyers trying to show that it isn't happening. So this is more of a legal issue and what you're able to prove. But the definition is any of these can be constituted to be dumping according to WTO rules, right? Now, what happens if you can show that a country is dumping? So suppose that India thinks that Turkey is dumping textile products in the Indian market, suppose. Okay. So the way it works is the following. So the WTO is going to look at the following prices. So it looks at P over T, okay, which is it's going to look at the FOB free on board price. So the free on board price is the price that Turkey is loading its products at in Turkey. So it's the price when it gets on the ship. And then P and P star are CIF prices, which means they are prices in the destination. So if we're talking about a Turkish exporter to the Indian market, P over T would be the price of that exporter in Turkey when it loads the ship. P is the price that it will sell at in India. And P star would be the price in Turkey of that particular product. Okay. Now, what is T here? T is the transportation cost. So it would be the cost of transporting the good from Turkey to India. So the way the WTO would look at this is it will say, okay, let's look at the FOB price in Turkey, which is P over T. If that price is less than the price that the firm is selling in Turkey, in the Turkish market, then that is constituted as dumping. Okay? So the FOB price in Turkey is less than the Turkish price. Now, if it does this, if it is established that the firm is dumping, then there's going to be an anti-dumping duty put on in the second period, right? So tau 2 is going to be the anti-dumping duty that India will put on, and that will be equal to the difference in these two prices. So because P over T is less than P star, and that's dumping, the tariff that the dumping duty that is put on is the difference between P over T and P star. So that's P star over P1 over T. And P1 is just the first period price, the price that it sold, the Turkish firm sold in the first period. Now, the problem with this is two. Dumping duties are very, very problematic because the first thing is there is an incentive for the Turkish firm to simply raise its period one price in order to avoid the dumping duty. Okay. So the firm is going to say, look, anyway, if I sell at P1 over T, I'm going to have to pay a duty to the Indian government, right? Which is the difference between those two prices. So why don't I just directly raise my price to P1 over T? Now, the problem with that is the government does get its intention, which is that now it's selling at a higher price, but unfortunately, the government will lose revenue. So if this had been a tariff, then the Indian government would have gotten revenue. But at this point, because this firm just raised its first period price ex ante, the government loses out on revenue, right? So that is one big problem with dumping duties. The second thing is often what will happen is the Indian firm will simply threaten an anti-dumping duty. And this happens in reality. There's just a threat of anti-dumping of a duty being levied that is going to induce the foreign firm to raise its price, and the Indian firm gets protection, right? So the problem with this is it is protection without the revenue. Okay. So this is a very, very problematic thing. And this is why in what we say is tariff is actually the least distorting way of protection. So if you do want to protect, you might actually be better off using a tariff rather than these types of duties. So things like anti-dumping duties, safeguards, countervailing measures. The problem with all of these is that these temporary trade barriers, we call them TTBs, are even worse than the tariffs. And I have given you an example for the anti-dumping duty, which because of these issues, it is actually worse than a tariff. And let me point out one other thing that with the anti-dumping duty. The issue with anti-dumping duties is there is continuing investigations. So it's not that you put on a duty and then that's it at the end, right? Because in the next year, that is going to be revised and there's going to be continuing investigation. Now, when that happens, then the Indian government will determine the third period duty. But in order to calculate what that third period duty is going to be, it's going to compare the price in Turkey and the second period price, right? The second period FOB price. And that's defined by P2 over T1 plus tau 2, because that is the second period price that the firm is charging, right? So this is the transport cost and this is the tariff. So unfortunately, if you work out the math, what you will see is the firm, when it is trying to avoid a dumping charge, it will avoid a dumping charge only if the price, right, this P2 over T times 1 plus tau 2, if that is greater than or equal to P star. Only then can it avoid paying a tau 3 duty, right? And if you work out the math, what that means is P2 has to be greater than or equal to that expression, which is greater than P1 times 1 plus tau 2. So to avoid these continuing duties, the import price must rise by P2 over P1 greater than 1 plus tau 2. And so what does that mean? That means that there is more than complete pass-through of the period 2 duty. So the period 2, so in response to the period 2 duty, the pass-through is actually greater than 1. It's not even 1-to-1. It's actually more than 1 because the incentive to raise price, the price must go up by way more than the period 2 duty at this point, right? So you get this escalating pass-through problem with these continuing investigations, and that can actually have very, very negative welfare impacts because as I said, everything about welfare impacts of tariffs depends on these terms of trade effects. How much of the burden of the tariff can you shift to the foreigner? That's the whole point. If you can shift a lot of the burden of the tariff to the foreigner, that's good. But here you will get this opposite effect where there's an escalating pass-through, right? So the problem with anti-dumping duties is three: incentive to raise price ex ante, which means you lose tariff revenue, or you start getting these other sort of cascading effects. And that is why an anti-dumping duty is worse for welfare than a tariff. Okay. Any questions here before I move on to quotas?
Yeah, so the difference, can you explain the difference between anti-dumping duties, countervailing duties, and the safeguard duties?
Oh, so they're very similar in some ways. So countervailing duties and safeguard, those are when, so if you can prove that one of your sectors has taken a hit due to, say, import competition from certain countries, then you can put on what is called as a safeguard duty. A countervail, so say, for instance, suppose you're arguing that with the China's accession to the WTO, there was just too many Chinese imports, and that just decimated textiles in India, and there was a lot of employment loss, and so we want a safeguard measure that's temporary. So it's again a temporary measure. And it's called a temporary trade barrier, and it is in response to a particular event. So you have to prove that your local industry was damaged because of that. So often it is very industry specific, and it is specific to a particular country, and you have to show that happened. With countervailing, it's about, they are putting on a duty on our exports, so we're going to put on a countervailing duty to match that, right? So it's a sort of a retaliatory thing. All of these are temporary trade barriers. I'm not doing a case to case. I don't have the models to actually look at the welfare impacts of each of these. But the bottom line is most of these temporary trade barriers, including countervailing duties and safeguards, are at least as bad as the tariffs. So tariffs are always marginally better. TTBs are much worse in welfare terms.
Okay, so the other one is, would levying of anti-dumping duties necessarily lead to trade diversion?
So levying of anti-dumping duties lead to trade diversion. I will have to think about that. So I'm not sure. So what is the meaning of that? Yeah, I mean, I guess it may. So if India puts on an anti-dumping duty that could divert trade away from India, yes, that is possible. Yeah, I think it can lead to trade diversion. Yeah, but we are focusing on it from a very, very narrow kind of way, right? So we are saying, what is the impact of welfare on India? So definitely by putting on a anti-dumping duty, you are raising the barrier for a low-cost supplier. And that is the welfare impact that we are trying to trace here.
Okay. Yeah, so I think there's one more which is asking if rules of origin can act as another trade barrier in the backdrop of lower tariffs.
Yes. So there is a big literature that looks at non-tariff barriers. Okay. So the ones I'm talking about are just tariff barriers, right? And non-tariff barriers are things like rules of origin, standards like environmental standards, labor standards, and so on. You can have that, and unfortunately, what is happening today is because tariffs are an easy way to so you can look at tariffs and you know what the tariffs are, right? But with non-tariff barriers, it's very hard to pinpoint protection. So a lot of times countries, because under the WTO, they have to keep tariffs low, what they will do is switch to non-tariff barriers, which are very hard to pick up because there are things like rules of origin and standards. And there, again, as I said, welfare effects of those things are always higher than for the tariff. The tariff is your least distorting measure, which is why the WTO prefers tariffs, right? It doesn't like any of these other trade policy measures. Again, I'm not talking about 100 or 150% tariff. When I say tariff, I mean a reasonable tariff, right? Anything like 10 to 30% tariffs, your welfare losses, even for small countries, are low.
Okay.
Anything else?
We have maybe 20-25 minutes remaining.
Okay, so I need to speed up. Okay,
Yeah,
so
we can.
I will speed up. So let me then make some few points. So first thing is import quotas. Import quotas are quantitative restrictions. So instead of putting on a tariff, you say you can only import a certain amount. You can't import above that. Okay? So let me make 3 points with the quotas. Here's an example of a quota, by the way, the multi-fiber agreement on textiles and apparel. It was lifted in 2005, right? And that meant that a lot of developing country exports to advanced countries started surging once these quotas were lifted, because these were quotas imposed by advanced countries on developing country exports. So they have been lifted now. Now these quotas are not in place. So let's look at what is better. If I'm India, I want to protect, right? Do I put on a tariff or do I put on a quota? Which one is better? So let's look at the equivalence issue. So here we have a small country. And if you remember this diagram, this is the usual tariff diagram that I had before. So on the right-hand side, I have a perfectly elastic export supply curve because it's a small country. And I have a downward sloping import demand curve. Now, what I'm going to do as a government is, suppose I want to restrict my imports. Earlier, the imports are M0 under the world price of P star. I want to restrict my imports to M1. So I'm going to put a quota that says, look, you cannot import anything less than M1, more than M1, right? So that means the quota is set at X bar. And so now this is a sort of a limit. So the export supply curve becomes a vertical line at this point. The impact of that is the new equilibrium happens where X bar intersects M. So if I trace that price to the left-hand side, the price increases from P star to P1. So the impact of a quota of X bar is exactly the same as a tariff in that the domestic price goes up from P star to P1. Now the question is, what about welfare, right? So it's the exact calculation. Consumers are going to lose A, B, C, D because the price went up. Consumer surplus goes down. Producers will gain A, and then B, C, D will be the difference. Then the question is, under a quota, what happens to the part C? Now, if this was a tariff, then the government would have captured the difference between P star and P1, which is T, which is the tariff, and it would have captured this revenue, right, the C. But under a quota, the government is not really getting tariff revenue, right? Because it's a quota means it's just a quantitative restriction. So then the question becomes, what happens to the C? And this is where the quota is different from a tariff. You don't get the tariff revenue. The question is, can you do a good job of capturing that C using quota licensing? So how do you allocate these quota licenses? If you are efficient, then you will allocate the quota licenses either by auction, or you will give these quota licenses to the most productive firms. Either way, you will capture C. But if there is rent-seeking behavior, in other words, you are giving the quota licenses to the firms that are bribing you, or you're giving it just to state-owned enterprises, right? That may not be as productive. If you are not allocating the quota licenses efficiently, this is where the quota and become non-equivalent. Even though the price effect is exactly the same, capturing the tariff revenue is easier with a tariff. However, with quota rents, you can't capture them unless you have an efficient system. Okay? So for developing countries, the WTO doesn't like quotas because they don't have efficient systems to capture that rent, that C part. Okay. Okay. The other place where it is not a good idea to have a quota, again, as I said, tariff is always the best, is that when you have imperfect competition in the market. So when you have domestic monopoly, then the quota is not as good as a tariff. So here we have a demand curve. So suppose this is the Indian market, downward sloping demand, upward sloping marginal cost. Okay? And this is the marginal revenue curve, right? So if you had a free trade environment, then the free trade price will just be P star. So what free trade does is it takes away the monopoly power from the monopolist. So at P star, the monopolist will produce where marginal revenue equals marginal cost, and that happens at Y naught. Okay? Demand is C naught at P star, and so imports are C naught minus Y naught. If the Indian government put on a tariff, price would go up to P star plus T, and at that point, demand is C1. The supply is going to be where it intersects marginal cost. So that's Y1. So C1 minus Y1 would be imports. Now, suppose the government wanted a level of imports C1 minus Y1, but instead of putting on a tariff, it says, I'm going to put a quota. Now, the monopolist acts very differently, because what the monopolist will say is they will operate on what we call as a residual demand curve. So look at this curve here, D minus M1, which means the demand just shifts to the left by the amount C1, Y1, which is the quota, right? So the monopolist says that, look, I am operating now on this residual demand curve. So I can produce and sell anything here, and the rest of it will be sold by the foreigner because there's a quota. The foreigner cannot increase their quantity because there's a quota. And so when this happens, and this is the residual demand curve where the monopolist is operating, their marginal revenue curve is given by this MR. And so then the optimal price will be P2 and production will be Y2. So what this is saying is, if you are in an imperfectly competitive environment with a domestic monopoly, you better not have a quota. You would be better off with a tariff, because with the tariff, the price only goes up to P star plus T, but with a quota, it goes all the way up to P2 because the monopolist is operating on this residual demand curve. Okay. So two things with non-equivalence: difficult to capture quota rents, and monopolists and imperfectly competitive markets, tariffs are not the same as quotas. Right? Tariffs are better. So I can hear the slide talks about Cournot and Bertrand competition. And again, what this slide tells you is not a good idea to have a quota when you have Cournot and Bertrand competition. So quotas are technically maybe equivalent to tariffs in some cases, but there are these non-equivalencies you have to consider. Okay. And the final thing, I don't have time to go through this, but this is actually an interesting one, which is quality differentiation. So here, this slide, we have a model where quality is different. So there's differentiation in product quality. And what this model says is, when you have a quota, right, you're going to have quality upgrading across products. So what quota does is it makes firms switch towards selling high quality products. And the reason for that is the following. The quota acts almost as a specific tariff. So it's like you're adding a certain amount to your price. And because the quota increases prices by a specific amount, the increase in price is actually lower for expensive products, right? So suppose the quota increases the prices by, say you're talking about cars. So you have a $3,000 car and you have a $10,000 Mercedes, right? So $3,000 is the cheap car, $10,000 is the luxury car. Suppose you put on a quota for imports. Then the quota is going to raise the price, but it's going to raise the price of the $3,000 car and the $10,000 car both by the same amount of $1,000. So the $3,000 car price goes to $4,000, which is a big increase, and the $10,000 car price goes to $10,000, so $11,000. Right? Now, if you're a consumer, you're looking at the change in price and you're saying, oh, wow, the cheap car went up to $4,000, which is a big increase, but the luxury car earlier was $10,000. The proportionate increase in the price is very small for the luxury car. And so that actually shifts consumers to the high quality products or high luxury products. And so quota results in what we call upgrading. So consumers and producers shift towards better quality products with the levying of a quota. Okay, so that's another place where tariffs and quotas are different, because tariffs, you don't get the same impacts unless, of course, it's a specific tariff, right? Okay, so I'm going to talk about one paper here, Khandelwal, Schott and Wei, a very interesting paper, 2013. Which looks at the MFA quota and what happened in China. So what the paper shows is that the Chinese government was very inefficient in allocating quota licenses. So they were allocating quota licenses without any auctions. They were probably just giving it to the less productive firms. And so there were huge welfare implications when the licensing came off. So when the MFA quota regime was dismantled, there were huge welfare improvements in China because now there is no quota license allocation anymore, right? All that corruption meant that there were welfare gains from institutional reform. So what this paper shows us is it's a bad idea to have a quota system if you have inefficient institutions. If you don't have high institutional quality, a quota can be very bad relative to a tariff. Okay, So let me quickly then go to export subsidies. This is going to be very repetitive because what is an export subsidy? It's basically you're subsidizing every unit that you're exporting. So the government gives you a payment for every unit that you export. Now, the thing is, the analysis is exactly like the tariff because it, again, will depend on whether you're a small or large country, whether you're in perfect competition, imperfect competition. Bottom line is export subsidies are really bad. They are very rarely welfare improving. The one exception is R&D subsidies. So if you're giving R&D subsidies to industries like the Airbus Boeing type subsidy, that could still be welfare improving. However, in general, export subsidies are horrible. And I will show you the one graph to make that point before I wrap up. Okay. So the WTO hates export subsidies, by the way. So let's look at export subsidy, and I'm going to go directly to the large country example because this is where the action happens. So this is the similar diagram to the tariff: left-hand side domestic market, right-hand side export market. One important distinction here is the autarky price is where the demand and supply curves meet in the domestic market, and that autarky price is lower than the world price P star. Why is the autarky price lower? Because this is a country that has a comparative advantage. It's exporting, right? So it has a lower autarky price. So let's suppose that we have, so this is what we call D star is the demand curve. So it's import demand. Now, because we're talking about an exporter. And this is the export supply curve. So suppose the first export supply curve is upward sloping because higher the price, more you're going to export, right? Higher world price means you export more. The demand curve, of course, import demand is downward sloping. Higher the price, lower the demand. The equilibrium in the international export market is P star. So that is the world price. And at the world price P star in the domestic economy, supply is going to be at point Y naught, demand is going to be at C naught. So the excess supply is going to be exported. So Y naught minus C naught is the level of exports. Now, suppose that the government comes in with an export subsidy. So it wants to encourage exports. It gives an export subsidy. What that does is at the same price P star, now exporters are going to be able to export a lot more, right? Because they're going to get that additional bump of a subsidy S. So at P star world price, what exporters get is P star plus S, right? So there's a bump up of the amount S, which means the export supply curve shifts to the right to X prime. So the new equilibrium here is P prime and then go all the way up to P prime plus S. Trace that back to the domestic market, and what you see is the same thing we saw with imports, but we'll see how this is different. So by giving on a subsidy, the world price has been driven down to P prime, and the domestic price in the country is P prime plus S here. Okay. So again, there's a wedge here. So there's a terms of trade effect, but this is the opposite. This is a terms of trade loss. Because what this country, so suppose this is a US with an agricultural subsidy, by giving its agricultural exporters a subsidy, because the US is a large country, it has driven down the price of its own exports. Okay. So this means it's a terms of trade deterioration, because terms of trade is the price of exports divided by price of imports. So the US drove down the price of its own exports, and the price that the consumers are paying is high at P prime plus S. So if you do the welfare calculation, consumers have lost, so let's look at the consumer surplus. So consumer surplus, consumers lose the point A and B. Producers have gained A, B, and C. Okay. So that means C is a gain here. But what about the extent of the subsidy? So the subsidy is the difference between P prime and P prime plus S. So S is the extent of the subsidy. Multiply it by the amount of exports, because for each export you have to pay the subsidy of S. And so that means that this entire section here is what we call a loss for the government, meaning it's money going out of the government pocket. So if you do the net calculation, what you will see is that this entire section, B, D, and the big section E here, all of this is loss coming from the export subsidy. And the extent of this rectangle E will tell you how big a terms of trade effect is. So the bigger the negative terms of trade effect, the bigger is the loss for the country coming from E. Okay. So essentially what we have shown is export subsidy is a really bad thing. Even with perfect competition and large country, because of this negative terms of trade effect, where a large country, a US giving an export subsidy is driving down its own export price, right? That means it is associated with large welfare losses. So this is why the WTO does not like export subsidies. There's distributional effects. Okay? Farmers will benefit from agricultural subsidies. The problem is it's a beggar thy neighbor policy. So who is going to lose here? Because the US gave a subsidy and down the agricultural price, India, which is another emerging exporter of agriculture, is also seeing a negative terms of trade effect. So the US is having a spillover effect on Indian exporters because it's driven down the world price for exports. This is why the WTO doesn't like export subsidies. Okay. Let me just conclude by giving one slide. And I have a few slides here talking about imperfect competition and what happens to export subsidies. And the answer to that question is, let me just jump straight to the answer here. Subsidies. So when you have imperfect competition, it really depends on which kind of market you're operating in. So whether you're operating in a Cournot competition or Bertrand competition, depending on that, it might be better. So Brander and Spencer show that if it's a Cournot duopoly, a subsidy is good. But if it's a Bertrand duopoly, then subsidy is actually bad. What you need is an export tax. And of course, you can't really have an export tax. It doesn't matter. Okay. So for the reasons that subsidies may not work, you can have subsidy wars where the US has an agricultural subsidy and then the EU and say India retaliate with their own subsidy, and that can only make the situation worse. Okay. When can subsidies be welfare improving? As I said, subsidies to R&D, when you can induce a firm to enter, right? So you can help a firm to enter the market, then the R&D subsidy can actually be welfare improving. Or just like with the tariff, right? Infant industry argument, if you can have subsidies in markets where competitiveness will improve over time, then it might make sense. Okay. So I will stop there with the subsidy. So what I want to do in the last 2 or 3 minutes is to just give you a big overview, right? So thanks to all of those who have stuck on. And what I want to say is, I know that it's a lot of material that has been covered in a very short time. I usually do this over a longer period, right? Like a semester or something. So you have been taking in a lot of information. So even if you forget everything that you have heard from me, I just want to give you some points that I want you to take away, right? So what are the take-home points? First thing is trade happens because of comparative advantage, right? So trade is good because it allows countries to specialize in what they're good at, export and import, and that leads to welfare gains. The second point, and of course, all the models that I showed you, they are just showing you the different sources of comparative advantage. Where does comparative advantage come from? Technology, endowments, and so on. The second point is there will be distributional impacts of trade. Some people will gain, some people will lose. So there is a role for domestic policy, and we talked a lot about this in the context of the HO model. There's always a role for domestic policy to ensure that those who gain then compensate those who lose. Okay? And then third, we talked quite a bit about different types of gains from trade. So gains from trade are not just restricted to one type. You have gains because of consumer real wages go up. That's an obvious one. Gains in variety, right? Consumers gain variety. Gains because there are pro-competitive effects. We saw that in the Krugman model. Markups go down. Gains in productivity. Firms become more innovative because they're facing more competition, and so on. So that's sort of the 3 take-homes from the first 3 lectures. And then the final take-home from today's lecture is, if you look at the whole range of trade policies, tariffs are the most benign. Right? Even though there may be welfare losses associated with a tariff for a small country, with TTBs and export subsidies, things can get much worse. So anti-dumping duties and so on are associated with much bigger welfare losses than a tariff. So if you want to protect, the WTO implicitly almost prefers you to have a tariff. And when you're evaluating any trade policy, consider a few things. Consider if it's a big country or a small country, if it's a price taker or not. Consider what kind of market you're operating in, because perfect competition is completely different from monopolies or duopoly frameworks. Okay? So I will conclude there, and thanks for listening. And I hope you guys do more international trade. It's a very exciting time to be doing trade. So please continue your research and please engage more with international trade topics. So thank you. And I want to thank Gautam very much. He has made my life very easy. All I have been doing is lecture, and he's been answering a lot of questions. So thanks very much, Gautam. I appreciate it.
No, thanks go mostly to you.
No, I think you took a lot of the questions.
Yeah, well, I've been doing very little work nevertheless. And thanks for, first of all, agreeing to deliver the lectures, for being part of our visiting fellow program. I hope everybody, liked the series of lectures. They were very helpful. And I wanted to say one thing. A lot of people were interested in having these recordings. So a lot of people were interested in having these recordings, and I had promised that I'll share them tomorrow, but there's going to be some delay. We will still have them out on CAFRAL website, but they need to be edited a little bit, and that is going to take some time. We are in the process of doing that. Will be done by that before next week for sure. So instead of writing to me tomorrow, maybe you guys could, if you are interested, visit CAFRAL's website once next week, maybe by Wednesday or Friday. And if you don't find them, you can just email me. But it should be there in the, it should be in the, on CAFRAL website.
Okay.
Yep, that's about it. And thanks everyone else also for joining in.
Yeah, thanks very much, guys. I really appreciated all the interaction. I really value it. It was great. Unfortunately, I couldn't see all of your faces and interact more, but we have to do our best with the technology, which wasn't too bad, I think.
Yes, I agree. All right.
Okay.
Thanks.
Thank you very much, guys. Thank you. Bye. Take care.
Bye.
Bye.